For those who are still outside the hall, kindly make your way to the hall as we are about to start soon. Ladies and gentlemen, we still have plenty of seats in the front row, so kindly fill it up if you want to have a better view of the slides. For those who just came in, kindly fill up the front row so you won't miss out any of the investment ideas. Again, I would like to extend a very warm welcome to all of you. We appreciate you taking your time off your busy schedule to join us here today. Ladies and gentlemen, please be seated as we are about to begin. A quick announcement here. For parking ticket, the hourly rate for the parking here is 2 ringgit. So kindly go to the foyer to validate your parking ticket for a flat rate of 7 ringgit during the lunch break. Ladies and gentlemen, kindly fill up the row in front to make sure that you won't miss out any of the interesting investment ideas and to have a better view of the presentation. For lucky draw, kindly fill up all of your personal information inside the ticket and then place it in the box located outside at the foyer. We'll be starting soon in 5 minutes, so please be seated as we are about to begin. Good morning, ladies and gentlemen. For those who are sitting in front of me, as well as those who are watching us through live streams from Facebook or YouTube. What a fine weather to kickstart a beautiful morning. Words can't describe how excited I am to be able to see all of you here with us, physically and virtually. I'm Alvin, and it is my pleasure to be your MC for this seminar. We are pleased to hold our second physical recommended fund seminar after 2 years of pandemic in this building here in One World Hotel. Thank you for joining us, and we hope you will get something fruitful today. Again, welcome to FSMOne Recommended Unit Trust Seminar for 2023 and 2024. Ladies and gentlemen, if I could have your attention here, please. We have an exciting day ahead of us, and I'd like to take a moment to walk you through the agenda. First and foremost, we have a series of insightful keynote speeches lined up that will set the tone for the day. We have a total of 9 speakers today, while our esteemed speakers will share their expertise and provide valuable insights into the current industry landscape and future trends. Fret not, we will have several coffee break sessions to make sure that you will have enough rest throughout this hectic day. This will give you an opportunity to connect with fellow attendees, exchange ideas, and make new professional connections. Before we start, allow me to share some housekeeping rules to ensure a smooth and enjoyable experience for everyone. Kindly put your mobile phone on silent mode during the seminar. We want to minimize any distractions during our session so you wouldn't miss out any of the interesting investment ideas. Furthermore, we kindly ask that you be mindful of the time during networking breaks and lunch periods and make your way back to the hall on time to ensure our seminar runs as planned. Also, FSMOne is currently running a 0% sales charge promotion on recommended funds for the first 100 attendees. You may get your unique promo code attached. Take note that the promotion is valid from today until 14th of July 2023 with terms and conditions applied. This promotion code only can be used to purchase FSMOne recommended unit trusts for 2023 and 2024. Please ensure that payment reaches us latest by 3 p.m. on the 14th of July. So if you're not one of the early birds, no worries, we are still having a promotion with only 0.5% sales charge on recommended funds. To be eligible for this promotion, you simply log into your FSMOne account and start your investing journey before the 28th July of 2023 with terms and conditions applied. Next, feel free to speak to our team. If you are interested in opening an account or seeking investment ideas, please talk to our client investment specialist, and any questions about stocks and ETFs can seek for our stock team. If you're keen to know more about our recommended unit trust or get more about market insights, you can talk to our research team. If you're keen to know more about recommended unit trust and you're keen to know more about managed portfolios, please approach to our managed portfolio team. And any inquiries on bonds, please seek to our bond team, and we also have our insurance team waiting to help you out. Also, we have added an element of excitement for our event today with a special lucky draw. We have some amazing prizes worth up to 4,000 ringgit Malaysia waiting to be won. And I'm thrilled to announce this fantastic opportunity for all of you. So simply collect 5 stamps to be eligible to get a chance to win great prizes. We have live quizzes to be randomly conducted throughout our event. To join, simply go to your web browser or from your mobile phone or tablet and search www.menti.com as shown and in the slides, and then you can answer the questions displayed within the time limit to get a chance to win 100 ringgit worth of prizes. If you do not have a FSM account with us yet, feel free to scan this QR code to begin your investing journey with us. Our live Q&A session today will be conducted with Slido. To ask questions, simply go to your web browser from your mobile phone or tablet and search app.sli.do. Enter the event code FSMRECFUNDS23 as shown in the slides, and then you can start posting questions. Now, it sure has been a lengthy introduction. Thank you all for waiting. Now, let us start our event. With much honor, I would like to invite Mr. Koh Su Cheng, the General Manager at FSMOne Malaysia, to give a welcome address. Can we give a round of applause to Mr. Kaur?
Ladies and gentlemen, good morning, and welcome to the FSMOne recommended unit trust seminars. It's a great honor for me to be here to address the gatherings of esteemed investors and market experts. Last July, our previous unit trust recommended seminars, the market sentiment was undoubtedly negative. But despite the market challenges and volatilities, 89% of our recommended funds last year delivers a positive returns, and 20% of it generated more than 10% return in the past 1 year. And it demonstrated the exceptional works of the fund houses and fund managers. And we think that opportunities always arise when least expected. And we are here to help our investors to capitalize on them and look for all the investment ideas. And we think that I also noticed that today there's also a change in atmospheres, which I see some of the happy faces here, which is not really the same as last year's, because last year I see a lot of unhappy faces, which I believe some of the individuals here should be able to generated some very positive returns in the past 1 year. And today, I also would like to highlight against the importance of portfolio diversifications and asset allocations. In light of the challenges we faced last July, and we think that markets has been very highly unpredictable, especially with the rapid changes, for example, like the emergence of technologies like AI, ChatGPT, which contributed to I think is one of the strongest tech rallies in the past decades. And we think that diversifications and diversify your portfolio into various asset classes, geographical areas and sectors is even more crucial to ride through the market volatilities and uncertainties. And by striking a balance between seizing profitable opportunities and also to diversifying your portfolio into various geographical areas, asset classes, and sectors is even more important at these times. And so then we only can build a resilient portfolios that delivers sustainable growth towards the years. And FSMOne here, we are committed to help you all to identify your portfolio blind spots and also to identify investment opportunities in your portfolios. And with our 45 recommended funds this year that span across equities, fixed incomes, and also across various geographical areas, regions, sectors, and also asset classes. It allowed you to expose to a wider range of diversifying investment options. And later on, market experts will also share their valuable market insights and also discuss on what to expect on the second half of this year. And it will also help to guide you all on where to allocate your portfolios with a diversification approach. And I also would like to highlight that these seminars is not only for gaining knowledge, and also it's also a place for us to connect and collaborate. And I encourage you all to also to interact with our fellow attendees and also our FSMOne teams outside the halls, and also to engage with our speakers during the Q&A sessions and panels discussions. And thank you, and enjoy the seminars, and I look forward to see you all again with happy faces in the next year's seminars. Thank you.
Thank you, Mr. Ko Su-cheng, for the welcome address. We will now move on to our first speaker of the day, Mr. Kevin Kao. Mr. Kevin Kao holds the title of Research Analyst for FSMOne Malaysia. He covers Malaysia, Indonesia, and developed markets and the investment products domiciled in Malaysia. He also holds a bachelor degree in Business Administration in University of Malaya. In this presentation, Kevin will be sharing the actions investors should take and how investors should allocate their portfolios using FSMOne recommended unit trust. Now, please allow me to welcome my friendly colleague, Mr. Kevin Kao, up to the stage.
Hello. Okay, hi, good morning everyone. Thanks for spending your time to coming to our event here. And yeah, I think that last year is not a good year, pretty sure. Or let me just ask a question. How many of you think that last year, 2022, is a good year? If you think that it's a good year, say yes. Oh, wow. It was a surprise to me. Well, so coming to 2023, how many of you, year to date, after we have passed through so many months, how many of you think that 2023 is a good year? If you think that 2023 is a good year, say yes. Yeah, I think so. So I hope that 2024 or second half of 2023 will continue to be a good year. Well, first and foremost, let me go into the disclaimer because my compliance asked me to do so. I will give you just 3 seconds to look at this disclaimer. 3, 2, 1, and here we go for our presentation. So first and foremost, it's just a very quick view of what happened in year-to-date wise. You can see that year-to-date returns, a lot of developed market is showing a divergence compared between the emerging market. If you look at some of the top lists there, NASDAQ technology, Japan, Taiwan, US, Europe, all these markets have registered pretty awesome return, pretty handsome return. But if you look at our emerging market, China, Singapore, Indonesia, not emerging, I mean Asian market, China, Singapore, Indonesia, Hong Kong, Malaysia, Thailand, not really satisfying return. So what is the main issue of causing all these, all these divergences? Basically, if you look at the right-hand side, the 2022 returns. So actually, I was quite surprised because some of you guys say that 2022 is a good year. So, well, 2022 returns, you can see that most of the developed market registered double-digit return. But on the Asia side, we are somehow resilient except for China. Well, I'm pretty sure that later some of the speakers will mention a lot of things about China, and hopefully you guys will gain some insight from that. So let us straight away move to our topic today, which is recommended fund. So just for information, as a research analyst here, I'm part of the investment team, and we do come up with this recommended fund on an annual basis. Well, why we come up with this recommended fund? Because we think that it will serve as it's a pretty useful tool, especially for investors like all of you guys, when it comes to the fund selection. So, in FSMOne, throughout the past few years, we have been integrating a lot of funds to our platform, and nowadays we have about 700 plus unit trusts on our platform from 29 fund houses. And I know that it's quite tough for you guys to select, so we segregate by category, including asset class, geographical sector, and we included our recommended unit trust methodology, which is quantitative and qualitative. And last but not the least, we come up with this, the 45 recommended unit trusts 2023 and 2024. So just a very quick introduction of what is our methodology here. So first and foremost, we come up with the quantitative parameters, because I know that for investors, right, it's very, very tough for you guys to predict what's going to happen in the future. But from the past, what can we indicate? Meaning that it's somehow like demonstrating the fund manager strategy to position their investment portfolio. So the historical performance is one of the consideration. Here we do consider the performance risk and expense ratio. So first and foremost, let me somehow illustrate about what we look in terms of performance. In performance, we not only look at a cumulative return. Basically, a cumulative means that from 1 point to 1 point, how many return you can generate from, let's say, 5 years ago to now. So if you look at cumulative return, it's somehow going to be adjusted. Let's say from 2018 to 2023. Let's say the fund just registered a very, very awesome return in 2020. Because of COVID, then it's gonna tilt the performance on a positive side. So in this case, we need to consider in the long term, is this performance gonna be sustained? If yes, then it's good. But if no, then yeah, it's one of our consideration here. Or except from cumulative performance, we do also consider on the calendar year return. It's one of the reasons that we think that sustainable consistency and resiliency is one of our crucial metrics in terms of performance. Apart from that, we do also consider a rolling year performance, which is, let's say, like the example I mentioned just now, 5 years. Let's say you bought a fund on 5 or the 4th years or the 3rd year, 2nd year or the 1st year, how many potential return you can generate from that. So this is just a very quick introduction of our performance. In terms of risk, we not only consider about a standard deviation, meaning that the volatility of the fund throughout the past few years, we do also consider the downside vol, meaning that let's say if you so not that lucky, you bought at the peak and at the bottom, how many potential losses you will achieve from that. So it is part of our consideration as well. So last but not the least, expense ratio. Probably you guys will ask us why we need to consider expense ratio in our performance metrics, since that actually the expense ratio is already included in a fund performance. Well, what I want to tell you here is this is recommended fund, meaning that we are recommending the fund instead of we are awarding the fund because based on the past performance. That's why we think that expense ratio is one of the crucial stuff to consider when we come up with this recommended fund. So with all the metrics I mentioned just now, in terms of equity and balanced fund, which we think that is more suitable for all those risk seeker, we think that performance are more suitable for them. That's why we think that 60%, we allocate 60% of weightage for equity and balance. For bond fund, because we think that bond fund is more suitable for those slightly risk-averse kind of people, and we think that 40% is a pretty good weightage. In terms of risk, we allocate 20% for equity and 30% for bond, and last but not the least, 20% for expense ratio in equity and 30% for bond fund. So next, just like I mentioned about all those mathematics, basically how we calculate this is we created a model and we input all the fund performance inside, and it automatically will come up with somehow a ranking at there. So next is the tough part, which qualitative parameters. Basically, after you come up with all these, all these ranking, then we had a very intense debate among all our investment team members here. So first and foremost, what we need to consider is a portfolio positioning. If you recall the example I provided to you just now, let's say throughout the years, the fund registered maybe a very impressive return, let's say for 100% in 1 year. So when you look at the fund fact sheet, probably, let's say, just for example, you notice that the performance is driven by just one fund, where, let's say, 50% of these holdings. So throughout the past fund, yes, the fund has registered a very, very good return, very handsome return. But when it comes to risk, let's say if the fund make the wrong choices, meaning that you're going to be suffered the drawdown of performance because of just one holdings. Hence, I want to emphasize again, consistency, resiliency, and sustainable return is what we always trying to provide to our investors. Next, fund size and management team. Basically, fund size, let's say in order to operate a fund, you need to consider fund size. You don't need it too big, you don't need it too small. And also the management team. You don't want your fund manager to keep change that, like every year, turnover is too high or what. So basically, these are some of the metrics that we consider. Of course, there are a lot of metrics out there, but this is the main 3 metrics that we consider. For the interest of time, I want to illustrate more, but too bad, because I've got only 12 minutes left. So let us straight away move to the topic, which is 89% of the funds, like Su Cheng has just mentioned just now, delivered a positive return since end June, like our call last year. Basically, you can look from the slide. Out of all the funds, only about 5 funds that registered negative return. So, yeah, I know this is the main point why we are here. Basically, it's a list of our recommended fund for 2023 and 2024. Yeah, for the interest of, actually I would like to introduce all the funds here to let you guys have some understanding about all these funds, but too bad for the interest of time, I only got 11 minutes left, right? So I only can go through a little bit elaboration about what we have made the changes for this year. So first and foremost, what I want to highlight here is we have included the Core Equity Asia, which the winner will appear to be the CAF-JET fund. So maybe you guys will ask, throughout the past few years, actually we do already have Asia ex-Japan category, but why this year we need to include this Core Equity Asia? And we think that actually it's quite unfair for investors when it comes to like they want to pick Asia fund, including Japan, and if we are not recommending them, we are not doing our best part in terms of this. So that's why in this year we have included a CAF-JET fund. Just a very quick introduction of this CAF-JET fund. Basically the fund manager adopt a very bottom-up stock picking strategy. And if you look at the fund fact sheet, it registered very impressive return in 2022, 2021. You need to note that a lot of Asia peers have suffered a lot of decline because mainly from China's side. While this fund manager, he made the right choice where he underweighted China in during that era. So that's one of the reasons of the good performance last year. So apart from that, we do also included new players in the Asia ex-Japan category, which one of the winners will appear to be Principal Asia Dynamic Income and also Eastspring Investment Asia Pacific ex-Japan Target Fund. For Islamic, we do have a new option for you guys, which is Maybank Asia Pac ex-Japan Equity I Fund, while the Core Equity Malaysia, a new winner as well, CAF Core Income Fund. So if you want to ask me about what's the main difference between a CAF Core Income and also our last winner, CAF Tactical Fund, why we choose this Core Income instead of a Tactical? Basically, Core Income Fund is more concentrated portfolio compared to CAF Tactical, and it will go more compared to CAF Tactical, it will bring you higher volatility. But if you are a risk seeker, then probably CAF Core Income will be a good choice for you. Also for the Core Equity Malaysia Islamic, we do have a new winner, PNB Sharia Growth Fund, to replace the last year winner, PNB Sharia Premier Fund. So basically, the biggest changes, the biggest difference between the PNB Sharia Growth Fund and PNB Sharia Premier is the PNB Sharia Growth Fund will slightly tilt towards small cap compared to the Premier Fund, which having on a large cap last year. So next, for this supplementary portfolio, actually nothing much changes. It's just that we do have one new winner for the Greater China Islamic, where RHB Sharia China Focus Fund appeared to be the winner. Just a quick introduction of what this RHB Sharia China Focus Fund. We have spoken with the fund manager, and the fund manager have a positive view, especially in the SOE, state-owned enterprise spaces in China. So if you want to have some exposure in SOE in China, then probably you can take a look at this fund. So next, for the supplementary portfolio, we do have one new winner, which is the MAMG Global Environmental Fund, where actually if you guys do follow us very closely, probably you guys will remember last year we do have this ESG space, but we focus on the winner is Manulife Global Aqua Fund. So actually what's the main difference between the MAMG Global Environmental Fund and Aqua Fund? Actually it's both feeder fund and target into the BNP Paribas. So the MAMG Global Environmental Fund is target to the BNP Paribas, and compared to the Aqua Fund, it will go more diversified approach. So basically, we think that if you are a more diversified kind of player and you are seeking some opportunity in ESG spaces, then we think that the MAMG Global Environmental Fund will be the good option for you. And last but not the least, for fixed income Malaysia, we do have M-Bond and also the Nomura I-Income Fund. So basically, Nomura I-Income Fund, we really want to recommend this fund last year, but because of this fund, it's the wholesale fund, and due to some operational difficulties, that's why we only publicly to announce it as a recommended fund this year. So I think this is the last part for our recommended fund introduction, where we do have new winner Amanah Raya Unit Trust Fund for Malaysia Foreign Exposure Fixed Income, and also a new winner for PRS Based Moderate, which is a Principal PRS Plus Moderate. Well, let us go to a little bit chill slide. So basically, after all this introduction, let me just go into some what's the difference between a core portfolio and also the supplementary portfolio? But I want to illustrate it in a nasi lemak. Well, actually, I'm a little bit hungry because I haven't had my breakfast. Well, when it comes to nasi lemak, definitely the most important things when it comes to nasi lemak is just two stuff, nasi and also the sambal. So when it comes to investment portfolio, it actually is the same thing. When you are building your investment portfolio, you wouldn't want to let's say just give you an example. You are very gung-ho on US tech. You wouldn't want to have all your exposure into US tech because ultimately, when you make the right choice, you get a handsome return. But what if you make a wrong choice? Then probably your portfolio will be suffered in some sense. So that's why we think that when it comes to portfolio positioning, we suggest investors to have a core portfolio, which is on nasi and sambal. Let's say I want to build a portfolio on US side. So US is my core portfolio. I have maybe, let's say, for example, 50% of my allocation in US. But somehow I think that, China tech do have some opportunity. Then I probably want to allocate my supplementary portfolio. On the other hand, I also think that maybe ASEAN, I feel that ASEAN maybe have a pretty good return in the next few years. So I allocate some more percent into ASEAN. So these all the things I mentioned just now, like ASEAN, China, those supplementary kind of portfolio, you need to consider it as those like egg, like kacang, ikan bilis, and also the drumstick. So basically, that's how you should come up with your portfolio with this strategy. So basically, luckily I do have 5 more minutes left. So let us go to some interesting part, which is a very, very quick market outlook. So if you look at this chart, it illustrates what happened. This chart illustrates changes in terms of SPX index, the S&P 500, and also the US leading indicator index, and also the best EPS, meaning that the earning per share, the forward earning per share for this SPX 500. So you can see that although last year a lot of people tell you about recession is coming, probably something bad going to happen in 2023. But interestingly, you can see that throughout the past few years, the SPX in terms of price is showing an uptrend. January, if you still recall, last year, December, a lot of people are struggling. A lot of people are telling you semiconductor will have this kind of inventory issue. It's not a good thing for semiconductor. But interestingly, January, when the quarter result announcement, you can see that, semiconductor rally in January. Coming to March, we see US regional bank failure. Actually, it's not only US, it's like SVB, Silvergate, even on the European side, CS. The market has experienced a little bit of drawdown, but also the market view is differently because the market think that terminal rate is already near us. And coming to recently, a couple of weeks ago, you can see that even the AI frenzy, mainly driven by the very good guidance provided by NVIDIA. And also one thing I want you to note, if you look at this chart, right, basically is the US leading indicator index. Even though last year the Fed has hike their rate very, very aggressively, but you can see that the US leading indicator index actually is still showing an uptrend, meaning that the US economy is not as bad as the Fed is hoping. So definitely when it comes to investment positioning, it's gonna be very, very tough for you guys to allocate. So some people are telling you the economy is good. Some people are telling you the economy is bad. How should you allocate your portfolio? Next, the interest rate expectation has changed drastically in the first half of 2023. Some of the incidents that I told you just now are some of the like Black Swan event. And also, if you look at the long-term inflation rate, you can see that despite the cooling inflation in US, you can see that the inflation rate is cooling. The terminal rate expectation trended higher. Last year, actually not only last year, you look at the March expectation where actually a lot of people are expecting the terminal rate we're gonna be stopped at maybe 5.25. But after so many things happen, what's the terminal rate? So basically the terminal rate means that the market expectation of the interest rate to peak. So basically you can see that terminal rate is much higher compared to now. So it's pretty confused for investors. What's the things gonna happen moving ahead? So I'm pretty sure that if you do have any queries, feel free to ask our investment expert from various fund houses in a panel discussion later. Next, recession plays the crucial role next. If you look at the newspaper, every single word from those financial newspaper are gonna tell you recession here and there. So the 5 things we think that investors need to take note on in the second half of 2023. First, Fed rate. Second, the corporate earnings. Q2 gonna be announced by probably next 1 or 2 weeks. Credit after the US regional banks issue, how the banks gonna maintain their credit lending. Inflation, how sticky, how stubborn will the inflation be? And also, last but not the least, recession. Why I want to put recession in the red box basically is because all these Fed rate, corporate earnings, credit, inflation, they will only lead to one stuff, which is how severe the recession, and has it been priced in? And last but not the least, I only have 1 minute left, so I'm going to go through very quickly where the tactical opportunity is. So basically, if you follow our page closely, you will notice that we investment team, our research team, we do come up with an article very, very often. So if you want to gain some investment insight, feel free to go to our website and take a look on what we have written throughout the past few years. Last but not the least, actually on every start of the year, we will come up with this IFAS key investment team. And here's a very, very quick guideline of how we think that the recommended unit trust that we mentioned today gonna fit into our 2023 house view. So basically, first and foremost, we think that DM is more attractive than EM. So these are some of the funds that you could consider. Second, if you think that ASEAN gonna be outperformed in the next in the coming years, then yep, these are some of the funds that you should consider. Next, Malaysia. Something interesting about Malaysia. Malaysia has been underperforming for years because of the political uncertainties. Of course, I don't have an answer about what's gonna happen in the next 1 year, because you know we still have a 6-state election, we still have a global recessionary fear, so still a lot of things to consider in Malaysia. But we think that in terms of fundamental and the price mismatch, we do see some opportunity in Malaysia. Next, defensive sector resilient during recession. If you are a believer of recession going to be severe, then probably this kind of defensive sector is one of your consideration. Next, sustainable investing is now important than ever. You can't deny the fact that the ESG transition goal is a must. And if you want to take some position in ESG spaces, MAMG Global Environment Fund will be a good choice for you. And last but not the least, for equity, we do have Japan. And this is our recommended fund for Japan, which is Aham Wood Series Japan Growth Fund. This is the last slide, which is a fixed income. We prefer the IG over high yield because of all these uncertainties, and short duration over long duration because we think that the yield, duration is the yield environment is more suitable towards short duration. And also for Malaysia bond, we think that the yield is already kind of stable at this point of time. So we think that if you want to have some position in Malaysia bond, these are some of the funds that you could consider. Last but not the least, feel free to visit our website, fsmone.com.my, for more information. And yep, that's all for my presentation, and see you in the next session. Thank you.
Thank you, Mr. Kevin, for sharing his ideas on how to navigate the waves with a resilient vessel. So, from the recommended list that Kevin has shared just now, you may notice the word principle appeared several times, especially for the Asia category. And if you have been with us for long enough, you may notice that they have been our top recommended fund for several years. So, and now we are pleased to be able to get the next speaker from Principal to give us some market insights. So please allow me to give a brief introduction of the next speaker. So, Mr. Wu has over 28 years of experience in the financial industry, and he is currently the head of investment management and products for Principal Asset Management Berhad. Now, I would like to invite Mr. Wu Mantai up to the stage from Principal Asset Management Berhad to share with us on how to navigate the intricacies of investing in Asia and diversifying your portfolio to capitalize on the potential for the growth in this dynamic and diverse market. Let's give it up to Mr. Wu.
That's good. Good morning, everyone. Thank you to FSMOne for inviting Principal, and in particular me, for coming to this morning's presentation and being the first speaker among all the external speakers. Now, I'd like to start off with the fact that even though this year has been volatile, but generally, if you have managed your risks properly, if you have diversified your risk, you would generally be able to make some good money. And of course, like the nasi lemak, you have add a little bit more chili, then you may have, depending where you are, you can make quite a good return. All right? Now, let's take on. Why do I say nimble, risk-aware, beyond noises? Lots of noise. Recession? Don't know. Numbers in US look strong, right? Europe looks weak. And in Asia, China looks, what happened? All right? The rest of us are okay. So what it means is you just need to understand what are the noises, especially those from the media. So you must remember what you read on the newspaper. Sometimes they put up a headline just to catch your attention and for you to read. It may not necessarily mean it's the right thing to read. All right, that's the part of it. Now let's go straight to it. This is something we put together somewhere end of last year, and you'll notice that we have the word quality first before we talk about income or growth. Why quality? Well, the question is because after these huge rate increases from last year, the dialogue became, would there be a recession in US and Europe? And periods of very poor economic growth, only the strongest, best companies survive. And maybe even in that period, they get market share. All right? So you want to go for quality. So overall, protect your portfolio. Then, because of the volatility from the uncertainty, then you would say, I need a steady stream of income for you to provide stability to your overall investment. But you need growth. Last year, there's hardly any growth in your overall portfolio. Most of us will actually suffer anything from those who are conservative, from maybe negative 5% to as much as 20-30% down. All right? So this is where you need to grow to recover what you lost and make on top of that. I mean, that's the ultimate aim of investing, right? You want to make more money. So that's why we have equality, income growth. In macro-wise, US, whether you like it or not, the numbers look very, very strong. All right? The employment in particular data look very strong. But then on the other hand, the technology sector, which has actually rallied, they are the first one to cut staff. All right? Now the question is, would that continue to feed into the rest of the system? All right? Europe is definitely not going to go anywhere. All right, mostly down. China's PMI numbers, unfortunately, is a culmination of a few factors. The manufacturing sector is going through changes. All right, people are talking about having China +1, +2. If there's no growth in the manufacturing sector, then that means your PMI is not going to grow. But China, at the same time, has changed. Unlike previously, manufacturing used to be 40% of GDP back in year 2000. Now it's maybe about 30 last 2 years. While services is now about 40% compared to 30% back in year 2000. So the structure of the Chinese economy has changed. All right? And if that is the case, that means there is a totally different demand for your workers, different type of expertise. And China, to some extent, part of its manufacturing sector will no longer be what it was 30 years ago. But they are so cheap, so efficient, I can produce something for you at 2 US cents or something like that. All right? So that is not applicable. That needs restructuring. That is also something the Chinese government need to tackle, which Malaysia went through after the 98 crisis. For a long period, the manufacturing sector didn't go anywhere. Right? Only maybe the last 8-9 years, the E&E came back big time. So China will go through a similar type of restructuring, which is needed. All right? Then you talk about inflation. At this point, the US government, what they worry is that the core inflation looks very difficult. Don't come down, all right? And previously was wage rate very stiff. Then recently, people ask, hey, how come shelter? That means people you go and rent, shelter become very, very expensive. Now, ask all of you, most of you may have kids, cousins, nephews over in UK or Australia. They can tell you how much rental have gone up from last 3 years. From maybe first year is maybe in London is 250, then it's 320, now it's 420, next year talking about almost 500. And you ask yourself, why is rental going up so strongly? You must remember, last 15 years, the world has zero interest rates, especially in US and Europe. All right? And suddenly, the guy who borrow money to buy the property and rent the room to you is paying 1% interest to 5% interest. You think the gentleman will absorb the additional 4%? It's all yours. Plus the 3-4% inflation rate. Voila. So you have things like that. And suddenly Federal Reserve say, I still want to raise interest rates. That means your rental will go up one more rate. The only way to break that is your property sector collapse. Or your economy really take a crash. This is something the government may not be willing to endure. You don't want to have huge amount of NPLs. Now you are going to what you call just a cyclical slowdown because of higher cost of doing business. Interest rate go down, go up, right? So everybody slow down. Suddenly you create something snap, right? Wow, that's going to be painful. Then market will take on a totally different condition. But if those of you who are very being vulture, you say, hey, interest rate going to drop a lot, I can position myself, right? But in the between, then how do you manage if there is all this happen? All the volatility that will ensue from there? This is where I think you need to be, put on the thinking cap, the nasi lemak style. Later I'll show you our style of that, all right? So you can go on. So your central bank policy, we know is, China definitely needs to put in more support, whether it's cutting rates, targeted stimulus. I think the most important thing in China now is to restore confidence, really, right? The rest is just dessert, all right? Then US dollar, will it peak? You reach a stage where people say, I don't want the US dollar anymore. I can't make money using dollar doing business. I need an alternative currency or alternative mode of exchange, right? So you have a lot of things converging. And for me, this means volatility. But as long as you know that no government wants anything really bad to happen, then they need to come out and support. Then how do you, at the end of the day, position for yourself for the final, for that take? But in between, you have to be very, very, talk to IFAS, talk to everybody, talk to your bankers as to what they think, all right? Now, let's talk about this first. This is World Bank's estimates for growth. This year is definitely a bad year, so-called, all right? US, Europe, I think US will be near to zero, Europe will be negative. But what is they tell you that 2024, everything comes back. That means next year is a synchronized growth scenario between developed country and emerging countries. Now, you must think of yourself that growth do not come automatically. Like you are driving a car, you want a car to go faster, you must step on the accelerator. So your economy cannot go faster without something to tell them to go faster or stimulate the people to do more things to make it grow better, right? And most of it will have to come from some level of policy support, which I think interest rate cuts will be one of the main driver of that, all right? So this is just to highlight to you, one, you want to take a lot of risks, it may be 2024, second half, because of the growth, synchronized growth coming back. But this year, definitely, until somewhere the next 9 months or so, is not a time to take a lot of risks. But what is also evident is Asia and China will be the fastest growing region in the world. This is something undeniable, all right? Even with the so-called issues that China face, it will still be growing, all right? Just now, this chart has been shown. I'm not to say too much about that. This is the core inflation part, all right? Then you have the interest rate outlook. Now, this is a question where people say how low it will go at the end of the day once it all normalizes. We have to accept the fact that inflation in US going forward will no longer be sub 2% for the last 15 years. That is not going to happen. Because that is when US economy is still having a lot of issues trying to recover from the global financial crisis. Post this, we are back to the normal world whereby there is no longer zero interest rates. There will be normal inflation. And if you believe at this moment, the market forecast that it will be anything from 3 to 3.5% as the bottom, then you go back to historical experience before 2008. Previously, interest rate, inflation, the gap is 50 to 65 basis points. Interest rate is always this high compared to inflation. What you call real interest rates, all right? So you think of the fact that, inflation, interest rate at this level, that means your inflation will be in the region of 2.5% to 3.5%. That means your interest rate will be anything from 3 to 4% or 3 to 4.5%. And you look at current level of 5.25, there's actually more than 100 basis points more of interest rate to go down to. Then you ask yourself, okay, will it be a fast cut or slow cut? Then you ask yourself how you want to put your portfolio together for that as well. All right? Next, when US peaks and all the stuff, US dollar will also peak eventually. All right? Because people always go to US dollar in times of recession, times of fear. And last year was an added bonus. For the first time in 15 years, you park your money in US dollar, you get a return. Before that, it was zero. Right? So you say, okay, put only no problem. US dollar cannot die one, right? Or something like that. Boom. That's why you have this very, very aggressive rate. And of course, all the forex dealers will be pushing it, to give you that, to give themselves the additional return. But usually, when US dollar peaks, emerging markets do better. People move out of US dollar and go elsewhere. All right? And of course, China, false start, right? Open, very impressive, boom. But usually, in previous experiences, when they allow the tap to open a little bit better, loans growth is good, the market always follow. All right? And recently, in somewhere end of June, the current new BBOC governor actually said something about loans growth impulse, loan impulse will continue to be positive. That's telling you that means their quota for loans is going to be expanded. So you think of yourself how you do that. And of course, on the other side, the foreign media say, oh, the Chinese, all the hidden NPLs will become a problem again. So up to you all to think about that, all right? Because there's been the hidden NPL problem has been around for last 30 years, right? So you think of it that way as well. So this is part of the awareness. Opportunities, we still like Asia. Macro-wise, inflation is less. We reopened from last year. Generally, we are still coming along. China reopened, strong numbers. I am not totally disappointed with China numbers, nor am I thinking why the Chinese government is not doing anything. No government will want to see themselves get into trouble because of bad policies. Somebody with more responsibility. Yeah? So, but generally, fundamentally, Asia is better. So I think we still like Asia. And one story I like to share with you is that despite last year, the whole of Asia looks so bad, there's actually two parts of Asia that actually, if you've been there, you make money. You have invested in India, or you have an ASEAN fund. So there's no absolutely, you cannot make money in such a situation. And I think India and ASEAN continue to be quite all right. So as an overall package, Asia not only have the Northern Asian dragons, and part of ASEAN is coming back, and India seems to be the new favorite for some of the people. Japan seems to have some positive news. I don't know how are they going to shift that, but I think at this point it's very much based on expectation what's happening in Japan. All right, so you think of valuation for Japan as well. All right. Now, I'd like to talk about the income part. I already talked about that. This is when US 10-year Treasury yield peaks. When it peaks each time, bond prices rally for the next 24 months by 7% per annum. All right? So this is a cyclical thing. Because you know interest rates and bond prices is one for one negative one, right? So it peaks, so it's a cyclical thing, bond prices rally. So this is something, if you remember, last year, despite continuous interest rate hike, but December, when it was a 50 basis point hike, global bonds actually rallied, even until now. And then in January last year, it still went up 25 basis points, but the technology sector actually rallied right until now. Why? Now you must remember, both are the two asset class most sensitive to interest rate changes and GDP numbers. And both most sensitive, then it actually can rally because of interest rates still going up. It's signaling to you there's going to be a pause coming soon in interest rates. So you take up you backdate it. December last year, January this year, last month they paused, exactly 6 months. People always tell you market very efficient, look all you in front, right? 6 months ahead, right? So sometimes it's work. And suddenly now the dialogue change, maybe can still go up higher. I would actually wish the Federal Reserve raise interest rates once or twice more and take it over with. If they want to crack the economy, break the momentum and actually have a real recession, go ahead. If not, all this partly it has to do with the fact that when inflation was high initially, they didn't raise rates aggressively. So they so-called lost face and credibility. So now they hold it so tight. No choice. Must get this back. So this is very important. No, credibility is very, very important in any policy making. All right? It's very, very important. Nobody believes you, habis already. All right? Then you talk about the other factor that is going to drive bonds performance. This is something that is happening across of Asia, but this is actually derived from Malaysia. Budget deficit as a percentage of GDP. So before that, 30% was okay. Plunge was, of course, at that time everybody give free money, right? The only few countries that never give free money is China and US. But they have actually their social system. So you have an improvement in the budget deficit situation. What it means is the budget deficit going forward for the next few years, not only in Malaysia, but across the Asia, and all those governments who are responsible enough wants to make sure that the budget deficit, even though it's going to increase, but it's by a smaller quantum going forward. If that is the case, that means the additional financing needed is less. Additional government bonds that need to be issued is less. That means less supply, better prices, right? And your rating agency will tell you, good job. So one, your government bond prices is going to look good. Your private credit should follow one. Bond is sometimes very, very obedient to our asset class. Interest rate go up, pop. Interest rate go down, go up. And then the government bond prices will always be the sovereign list. If the government looks good, the rest of the private economy should look good. So they follow also one. So structurally, you have this thing happening within the fixed income space to drive how bond performance may go and last beyond the next 24 months, right? Right until 25 or 26. That depends on how things go, right? So that's the other two. So there's two factors. You have a cyclical factor, you have a structural factor, all right? Why I'm starting this is part of overall diversification because you still have a lot of volatility. This is very important, okay? Next, you have got the China PMI. This one you show how it's made, but the June data came out. Manufacturing improved a little bit, but not a lot. It's still not above 50. Services continue to drop a little bit. Like I mentioned before, right? Manufacturing sector now is the smaller part of the economy compared to the year 2000. At the same time, the structure of the manufacturing sector currently is catering to the situation 10 years ago. Because the manufacturing sector cannot just change overnight. Suddenly, I transform a cement factory to an E&E factory. No, you can't do that. It's not like you go to a bank, I want to switch my 6 months FD to 12 months FD. Immediately can be done. That is a product, you must remember. Your FD is a product. But manufacturing, you cannot do these sort of things. Right? And at the same time, after 2018 trade war and the supply chain disruption, everybody will say that acknowledge the fact that I need to have a China +1, China +2 supply chain elsewhere. Maybe India or the rest of ASEAN. And if that is the case, like Apple is a good example, right? They say in China my business continue, but my capacity remain. All new capacity growth is outside of ASEAN, but PMIs measures growth. And then at the same time, China's economy has changed. Manufacturing is no longer the largest. So certain sectors inside the manufacturing sector will not be growing at ASEAN, like cement production. So you have all this shrinkage feeding through the system. So that's why I allude to the experience of Malaysia back in the 90s, especially in the mid-90s onwards, right? So same thing. So this is where I would say that the Chinese government going forward have to talk about how to re-weaponize their manufacturing sector. Despite all these things, as long as you can produce something cheap, somebody will buy from you, or efficient enough, or good enough, right? But at the same time, services become more important. But services, you talk about different types of services, from financial services to etc., etc. Then you talk about different type of people, different type of industry, different set of policies to drive that and preserve the growth, right? Very, very important. So you talk about next 5 to 10 years, the Chinese government actually have no time to quarrel with the US. There are internal issues that they need to address. It's far more important than whatever the Western media say about them, right? That's the reality, right? Not to say I'm pro-China or anything like that, but domestically, they have a lot of things that's happened. A lot of it converge at the same time, all right? Things have changed. You have no choice. You have to do something. And you have to do it and it's a longer-term thing, right? Last time, they start from zero when they reopen the economy. Everything is zero. Everything is so cheap. Grow only. But you are now no longer zero. You are like, their per capita GDP will be in like Malaysia 15 years ago. 10,000 US per capita, per head, right? So you are reaching a different stage. A bank branch manager in Beijing earns more than a bank branch manager now in KL. All right? Reality, all right? This is the other thing that's happening. Last 3 years, no businesses hire anyone, but every year they have 7 to 9 million fresh graduates or young people coming out, O-level, A-level, diploma, university graduates. 7 to 9 million people. So for the last 3 years, they generated something like 27 million, almost 27 million unemployed young people, as well as people who lose their job. This year will be another 7 to 9 million, next year another 7 to 9 million. You're talking about a population of Malaysia floating around looking for a job. And when you have people without a job, eating up savings, maybe their own, which they don't have, which most likely will be their parents, that will be an issue for the economy. Because spending is now, services is now a larger part, consumption, larger part of the economy. When that is not growing because of high unemployment, you have an issue. All right? You need, what that means? You need to create jobs, pay salary. Young men go like, tonight, we go somewhere, right? That is something to keep things going, okay? The other thing is this. This is an income distribution known across the world. The rich is always the lesser part, the poor is the larger part. But the other part China faces is they already have, before this, they still have pretty high poor people. 40% of the population. That means 560 million people. But last 3 years, you would not be 560 million anymore. You would be easily 600 million people. That means half the population became poor. That is another impact on the economy. Because when you are focused on staple food only, and not going out to have a beer, your consumption cycle, your economic cycle ain't going to be very, very dynamic. So you have the current situation environment as well. All right? Then, is that really all bad news? Not exactly. The Chinese save a lot of money. This is something they save every year in trillions in renminbi. Last few years, nowhere to go, all lockdown, huge amount of savings generated. But how come they're not spending money? Well, a few things happened, right? Household consumption is only 39% of GDP, right? US is much bigger, Malaysia is also much bigger than that. Then you ask yourself, why do they not consume so much? Do they really save so much money? There's a few things. It's a structural thing. It's a two-layer to that. One is the fact that you must remember it's a centrally planned economy. The government is a large part of the economy. So in technical terms, they call it crowding out. People will tell you it's a crowding out effect. As you can see, in US, private spending is 70%, but they is 60%. But look at the number of government, the percentage of the government, 23%. US 70%. All right, corporate is no different. So what it means is the government suck up a lot of the money and not pass it to that. And you look at the fact, even India, which is so poor, their welfare system, the social benefit is far higher than China, what China pay out. You must remember, this is a transfer of wealth, from the government to the people. It's an income effect. And you do not see that, all right, in China. And this is also the other opportunity. Then you ask yourself, how is China going to improve on social benefits or retirement safety net? They may adopt what the US is doing. They have something called 401k retirement plan. Here is PRS. So private companies and all that stuff. Oh, I've got 6 minutes more. I better rush. Right? I took too long already. But this is a situation that the opportunity Chinese is talking about. All right? Then the other problem that you see is the outflow of money to buy the property in China is become higher and higher. That means people spend the money to buy property and they don't consume. This is another issue the Chinese government. That's why when given the lockdown, the situation the property sector faced, and statistics show you that 70-80% of a common household wealth is in the property they hold, and the secondary price market is bad, nobody's going to spend money. Nobody will tell you the government don't know what they're doing. All right? I see my property value dropping on a monthly basis, blah, 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 blah. Confidence loss, high unemployment. All right? Quite similar somewhere. All right? So this is what I think is, one, you need to control your housing costs. This doesn't mean that you take over the entire property sector. You need something equivalent to HDB, far larger scale in Singapore, HDB. All right? You need to boost labor income. That is definitely you must. That means you must upgrade your overall sector. This is the part which all of us here are trying to do. Raise return on household wealth. Welcome to FSMOne. We are giving you opportunity to raise your income wealth. This is one, all right? Okay? And then increase government transfers. You think of all these things, all right? This is where you think of the policy direction that the Chinese government have to move forward. This is it. These are the things. These are the things, this is more qualitative than quantitative, but it has to be done in one way or another, all right? Of course, the other one, which is how the manufacturing sector, I think I give it the example of Alibaba, supposed to be broken into 6 different units, which means currently Alibaba got 6 different businesses within Alibaba itself. Some growing better, some not growing so fast, but all competing from just one source of resources to grow. So they need to break it up, provide opportunity for the better growing one to able to get money. The one not so good one, you survive, don't survive, I don't know. This is the reality of the manufacturing sector, which the Chinese sector have to face, which is no different than what Malaysia has went through in the late 90s until 7-8 years ago. All right? We talk about ASEAN. I say last year, ASEAN is the best growing performing country in the region in the world, together with India, partly the fact that we continue to attract lots of FDI. Going forward, more FDI will come in, more easily double the current amount going for the next 5-10 years. All right? Then you talk about the fact that in terms of correlation, we are much less volatile. That's why money automatically flow out to ASEAN last year. Because China was so volatile, right? They said, oh my God, I want to take part of my money, a lot of my money out of China, and I need to park it somewhere else. So it went up in India and ASEAN. So it continues. So in terms of the diversity of ASEAN is quite attractive. Think of it that way. Then next 24 months will be tourism coming back. At the peak, this is how much tourists spend in ASEAN. Now you're back to somewhere here only. So next 2-3 years, you still have talking about how to come back to this level. Ayo, sorry. All right. So this is the situation. All right. Okay. Conclusion. We still like US assets. We like Asia. We like ASEAN. All right. Here, I like to stress a little bit about China. A lot of people have all this lots of uncertainty towards China. I will put it this way. China is no longer the China 30 years ago or even 15 years ago. Things have changed. Even without the Americans or the developed countries creating all these political issues lately, their structure themselves have changed. All right? And once you reach a very high base, your growth automatically slow. Right? Because it's bigger and bigger growth, right? That automatically, people will ask the very simple question. Your growth has slowed from 20% to 11, 12%. Should I still pay you 20 times PE valuation, or should I pay a lower PE valuation? And on top of that, now you have all this so-called volatility from the political risk premium. So suddenly, previously, if you value China using a 7% discount rate, last year you may be using 12% discount rate. That's why the Hang Seng dropped from 30,000 to 15,000. But going forward, what is reality? The reality is the discount rate that you use will no longer be 7%. It will be nearer to 9 or 10 or something like that. Then that means the previous PE that you are willing to pay for China, which was 18 to 20 times, will now be a lower PE. There's a de-rating effect because you have a higher discount rate. So at this point, people are still grappling so what is the fair value for China, Hong Kong now? No, so much uncertainty. Economy is changing. So that's why you see Hong Kong, go up, come down, go up, come down, same thing. And you realize the A share market outperformed his share market. You compare it that way. Right? So this is a situation whereby market needs clarity. This is where the policies, I hope Yellen go there and say something generally okay, ladies charge, more gentle perhaps. We can get something moving. So this is where I believe doesn't make China uninvestable. It is still totally investable. There's still a lot of opportunity, but you need to frame the risks of China differently. The volatility that you face in China differently. The question to ask yourself is, China, can I break it down to A share, H share, equity, bond, in terms of diversification just within China itself? Nothing like that, yeah? All right? And if all the time you always have every dollar, 30 cents go to China, you ask yourself now, should I actually reduce it to less than 30 cents to contain the volatility? Or I maintain at 30 cents, but the rest of my portfolio had to be more conservative to make sure that overall volatility from China is controlled. Think of it that way, right? So quickly through, give me 30 seconds to do some self-advertisement. All right? This is what we have at this point, neutral on developed country, blah, blah, blah. We used to be positive on developed country because US, Europe went up, make money, we went to neutral. But then our underweight US, Europe went to Japan overweight, all right? The rest, we are still there. And why will we put this way? This is self-advertisement, all our funds. I can't put other competitors' funds to compare, but this has to do with the fact that conservative, mid-range growth. And this is conventional. So, why I say quality very important, you ask why? My Global Titan funds, don't you know it, generally focus on the largest cap developed countries companies. Quality companies. LVMH, Microsoft, you name it, the best quality ones. All have zero borrowing, business model tak boleh mati punya type. Alright? Sure can go. Alright? LV cannot sell, MH sure can sell. No, that's a reality, right? Think of it that way, right? But what you notice is, bond is good. APDI is there. This is your sambal or chili padi. It's shown, right? You've seen that. Last year was right down here. See, within 1 year, this is as of June. Suddenly it came back. Greater China is here. This is a reflection of the risk. All right? You stretch it out to 3 years. ASEAN is right up here. So this is an efficient frontier. Anything above the frontier, that means the fund manager did hell of a good job. All right? Then your Global Titans, this is the other one that some of you may be right. You notice that bond fund still there, global tax here. So you're talking about how you want to create your own best tasting nasi lemak for yourself. And then this is 3 years. That means you recapture all the volatility from last 2 years of COVID already. Okay? Then next is you stretch it to 5 years before COVID. Suddenly it tells you should actually have more bonds. With 20%, this type of volatility compared to this. Of course, this one very exciting lah. All right, everybody shocked. But then when it dropped last year, a lot of people not very happy. Right? So you want to make sure that whether it's 5 years, that's a 10-year one, but that one is too far away lah. That's right. So let's say you give yourself a 5-year planning horizon thing. You think of all this. So how do you want to position all this stuff? Not only with my funds, of course, iFast got plenty of that for you, even all the things. But this is for my own self-advertisement. This is what I show you, and this is what you have. All right? Thank you, everyone. Thanks for your attention.
Thank you, Mr. Wu, for sharing us with some of where are the opportunities at in the Asia market. So, okay, so before I let you off for break, let's look at some of the slides here first. We have 0.5% sales charge promotion on recommended funds, and to be eligible for the promotion, simply log into your FSMOne account and start your investing journey before 28th of July, with terms and conditions applied. And if you have any inquiries on any of the investment products, feel free to approach any of our teams here listed here, located in the foyer. Also, we have live quizzes to be dropped out randomly conducted throughout our event. So to join, simply go to your browser from your tablet or your mobile phone, and search this menti.com as shown in the slides. And we also have added an element of excitement for our event today with a special lucky draw. So please stay tuned for that. And if you do not have a FSMOne account with us yet, feel free to scan this QR code to begin your investing journey with us. Now, ladies and gentlemen, it's time for a well-deserved break. We have had an engaging and information-packed session so far, and now it's time to recharge and network with your fellow attendees. During this break, we invite you to visit the designated refreshment area where we serve an array of beverages such as coffee and tea for you to energize you for the rest of the event. So, ladies and gentlemen, we will take a 20 minutes break, and the seminar will resume at 11 a.m. We have an exciting lineup of sessions and activities planned for the remainder of the event, and we do not want you to miss out any of the valuable moment. Thank you, and we hope to see you soon. In the meantime, you can take this opportunity to gather your lucky draw stickers and fill in your personal details and place the ticket at the lucky draw box to stand a chance to win prizes worth up to 4,000 ringgit Malaysia. Ladies and gentlemen, we have 5 more minutes left before our event resumes. Ladies and gentlemen, kindly make your way back to the hall as we are about to start soon. Ladies and gentlemen, kindly make your way back to the hall as we are about to start soon. Welcome back, ladies and gentlemen. We hope that you had a rejuvenating break and had a chance to connect with your fellow attendees. As we resume our event, we kindly ask everyone to please make your way back to the main session area here in the hall. Before we continue, kindly put your mobile phones on silent mode during the seminar to make sure you wouldn't miss out any of the interesting investment ideas. Next in line, we have Miss Esther Teo from AHAM Capital Asset Management. Ms. Teo brings more than 20 years of investment experience in managing institutional and unit trust funds. She is currently the Senior Director overseeing the Fixed Income Division. She is also a CFA charter holder. In this session, Ms. Esther will delve into the Asia's economic growth, evolving market environment, and the impact of global factors on Asia's fixed income markets, providing insights for investors seeking to navigate this dynamic landscape. Without wasting any time, please join me to welcome Ms. Teo up to the stage.
Hi, good morning, everyone. How are y'all doing? Good. Good to see all of you today, and thank you so much for having me. So I can see that I'm the only speaker for bonds today, and I'm just wondering in the crowd, how many of you invested in bonds or have experience investing in bonds? Okay, I would say it's not a majority. I think more people are less familiar with bonds compared to equity or stocks. So let me just start with a little lesson about bonds, right? A very quick one. When you invest in a bond, basically you are a lender. You are acting like a bank, right? And you are lending money to bond issuers who are generally either governments or corporates or banks. So if you lend your money to a government, you expect to be paid an interest rate, right? Like a loan. And the safest is to lend your money to a government because the chance of a default is lower compared to, let's say, you lend your money to a company. But again, there's definitely different risk when you lend money to different government. For example, if you lend money to the Malaysian government or the US government, the risk is different from if you lend your money to Argentina, which has shown many times of default history. So what I want to highlight here is not all bonds are the same. The other thing is corporate bonds as well. You might be hearing terms like investment grade or high yield, or what we call junk bonds. So the difference is that bonds, because to help investors understand the risk, we have these companies called rating agencies that rate how safe or how risky are these corporates or banks. So investment-grade bonds refers to bonds that are high quality or rated BBB and above. So they are much more stronger in terms of their credit profile. And high-yield bonds are basically companies that could be weaker in terms of their, having higher borrowing, higher leverage, or weaker cash flow. But of course, if you are a bond investor, you want to demand a higher interest rates when you lend to high-yield, issuers. So that's a very quick history on bonds. Let me just move on to show you that, why do people invest in bonds? And so I have been in the bond market for over 23 years, 24 years now. And I've been with AHAM for about 20 years. So I have been in the market for quite a number of years. And over the years, what we've been telling investors and what is the objective of investing in bonds, there are really three things. And we have a lot of clients who are pension companies or insurance companies, and they generally keep about 60–70% of their investment into bonds. There are three reasons why they like to do that. Number one, because you are a lender, you are paid a fixed interest rates, and if there is no default, you will always get back your capital. Is that right? So for pension funds and insurance companies, what they want is the regular income. So bonds give you that regular income. And secondly, bonds are generally less volatile compared to stocks, right? So in the history of the last 100, 150 years, bonds generally give you a lower volatility and generally a positive returns. Because unless you have a very sharp interest rate rise or very, very bad crisis where there's a lot of defaults, you generally will get back your capital. So they will provide you that stability of your returns. And lastly, because bonds behave differently from equity market, we tend to have, you can actually make sure that when you have a portfolio of both stocks and bonds, you can balance out the risk and reduce the overall risk of your portfolio. So here I have a 10-year track record of different segment of the bond market to show you how bonds have performed. So here what I have shown you is, from 2013 to 2023. And from the top to the bottom are basically the different segment of bond market that have done the best and to the worst performing segment. So remember when I first started the session, I said not all bonds are the same. So it depends what kind of bonds do you invest in. You could get different returns. And if you look at this chart, I hope you can see, generally bonds give you positive returns year on year. There are certain periods where in 2018, for example, some of the segment give you some negative returns. But even if you suffer losses from bonds, usually it's less painful. You might lose 2%, 3%, but it's not as significant as stock market. However, take a look at 2022. And for those who have put up your hands, who have exposure to bonds, and including me, who has been in the market for over 23 years, last year was the worst year we have seen in terms of how bonds have performed globally. And when I say the worst year we have seen, I'm talking about even going back as far as 100 years. We have not seen how bonds have given negative returns of more than double digits across almost all segments of the bond market. So it was a horrendous and very tough time for bond investors last year. And, I think the earlier speaker, and I'm sure the rest of the speakers today will be also talking about inflation, this word, inflation. So I just want to share, why is it that the bond market had such a bad year last year, and what is the outlook going forward? Are we going to expect bond market to continue to see negative returns, or are we going to see a turnaround? So before I start, why is bond so sensitive to interest rates and inflation? Why is inflation the enemy of bond market, right? So if you are a lender and you have given a loan or, you bought a bond for, let's say, you buy a Malaysian government bonds and you bought it at 3%, okay? But then Bank Negara decided to increase interest rates to 5%, let's say. And basically what happened is a new investors who buy the new bond now can earn 5%, but you bought your bond at 3%. So is your bond worth more or less today? It should be worth less, right? Because now you are only getting paid 3%, whereas the new guy is getting paid 5%. So the market value of your bond will go down. So this is what happens when interest rate rise, and the impact on the existing bonds will be negative. But is it good news for those who are coming in to buy at 5%? Yes, right? Because they are getting paid a much higher interest rates. So that's why there is this negative correlation between interest rates and bond price. And in 2022, we have seen that the US Federal Reserve, the US Central Bank, had the most aggressive interest rate hikes in a very short period of time, where over 10 consecutive meetings, they hiked over 500% or 500 basis points, or over 5%. And that is a tremendous interest rate hikes, and it caused all sorts of correction in the marketplace, whether in equity market or the bond market. So last year we saw that there was nowhere to hide. All asset classes were hit badly. So just go rewind a little bit. Why did the Federal Reserve have to hike so aggressively? Why was inflation so high? And is it going to go under control, or are we going to see inflation going higher going forward? Yeah. So to answer that question, we know back in 2020, when we were all hit by the COVID pandemic, every central banks and government was so concerned that are we going to a Great Depression, right? I mean, never in our lives that the whole world shut down. So because of that very dramatic pandemic, central banks and government, they work together and pump in a tremendous amount of money into their different countries, right? Globally, in 2020, more than 10 trillion was spent because of the pandemic, just from the fiscal, means from the government, excluding the interest rate cuts that we have seen. So what I want to say is that a lot of money went to consumers' pockets, businesses, because we had to prevent a meltdown. And hence, in 2020, despite the pandemic, we had the shortest recession in history, 3 months of recession, and we had a strong recovery of bond and equity markets. Because so much money went into the system, and investors, when consumers feel rich, what do? They start spending. So this is especially so in the developed markets, like in the West, in the US, UK, Europe, Australia. They have spent the most. In Asia, I suppose because a lot of our Asian economy is smaller, we don't have as much firepower or bullets to give out to our rakyat. So we did spend quite a lot of money, but not as to the amount like the US. So when the pandemic subsided, everyone got vaccinated, reopening, we saw US had a very strong economic recovery, right, back in 2021. And inflation started to actually speed up and go higher and higher. But at that time, central banks thought, this is just a temporary thing. It's not going to sustain. But by the time they realized that this inflation is not going away, from March 2022, that's when they decided, hey guys, we need to hike interest rates and we need to do it quick. Why? Because the Federal Reserve is worried that inflation become unanchored or runaway inflation. Why is that so dangerous? If you think about it, if you think that prices will continue to rise, right? Let's say you want to buy a bag and you think that, price is going to go up 20% next year. What are you going to do now? You will buy now. If everybody thinks that way, what happens? The price will go up because you fulfill it yourself, right? So this is what we call inflation expectation, something that central banks are very worried about. So they always talk about price stability. they want to keep price to increase by about 2 to 3%. That is the sweet spot, where there is still some price increase, but not inflation that is run away. And that's why they have to hike interest rates aggressively. At the peak, the US inflation hit about 9%. And in UK, it's even worse, more than 10%, and it's still staying around there in the UK. So we are seeing a landscape where there is a lot of uneven recovery and uneven monetary policy around the world. And that's where we think is interesting. And we are seeing opportunities and also risk in various segments of the bond market. So now the Fed has hiked 5%. What's next? So in June, the Federal Reserve finally said, okay, let's take a pause. Let's take a pause and re-look at the data and see whether what we have done over the last 15 months have been working. And now they are able to take a little bit more time. Rather than the last 1 year, what they've been doing is every meeting, hike 50 basis points, hike 75 basis points. So that's why last year it was a very tough market. But this year, we are still not 100% out of the woods because we think the Federal Reserve is likely to still need to hike about 1 to 2 times in the third quarter before they can be more comfortable and say, I think we got inflation under control. Right? So I think this is the theme that I want to focus on, that we are a lot nearer to the end of the rate hikes as compared to the start of 2022. And for our bond investors and the long-term investors, I think it's good news because we are getting paid for the yields and able to ride on the higher interest rates at this time. So like I mentioned, the Fed is having a dilemma. So inflation is still staying higher than what they like to see, more than the 2%. Although I must say that it has come down from the peak, right, from 9%, and now it's about 4%. So it is seeing some improvement, but what they also want to see, very weird, is that they want to see that the labor market, the unemployment rate, they want to see it going higher. Why? Because now the employment market in the US is very hot, right? Even though last night we have weaker numbers in terms of the non-farm payroll, but overall, US labor is still able to demand high wages growth, over 4%. And, that's why the Fed said, I think we need to slow down the labor market to basically control this inflation. Because this inflation came from, like I mentioned just now, the strong demand due to all the stimulus and a strong labor market. So people are feeling rich and they're still spending money. So they have to engineer a slowdown. What is the potential risk here? The potential risk here is the Fed become overly too tough, right? If they hike too much, then it could cause a major recession down the road, right? Because there is a lag impact between when you hike interest rates and when consumer will feel the impact. So if you were to listen to any market outlook early this year, I think most market commentators would say that, this year we think that the US will go into a recession, or China reopening is going to be the story to go, and we're going to see that bond yields have peaked. And in the first quarter, it did seem that way, right? China reopening was seeing some strong data. We saw that bond had a very, very good rally in the first quarter. But then in March, that all came crumbling down again, right? We saw that the high interest rates in the US and around the world are causing some stress in the systems. From US regional bank, we had seen 2 banks that actually went under. And what we saw in Europe, the Credit Suisse. And there's also concern about the US mortgage, the commercial real estate sector, because post-COVID, offices in New York City and other major cities are seeing high record of unoccupied space, right, up to 20%. So there are some signs that the high interest rate environment is showing some impact. But what is kind of market was surprised is how strong the consumers are Consumer spending continue to be strong because during the pandemic, they have been given a lot of money by the government. And also in the US, 90% of their mortgage are fixed rate. So people who have bought their houses before the pandemic or during the pandemic have locked in very low interest rates. And even with the Federal Reserve high interest rate, it's not going to impact them. Unlike in Malaysia, right, you and me, when we receive our bank statement, and we're like, oh, our mortgage payment keep going up. And that's the situation in most part, like in Australia or Canada, UK, is similar to our mortgage, which is floating. But in the US, because it's fixed rate, consumers are seeing a delayed impact on these rate hikes. But we do believe in the second half of this year, there will be a slowdown in the US consumers. Why? Because things are getting more expensive. Number two, a lot of this stimulus will be taken away. For example, the student loan moratorium that was given to US consumers will be taken back as well. So they will feel a little bit tighter in their wallets. Yeah, so we think that second half, we see a slowdown in the US economy, which will then likely to see the Fed stop hiking rates in third quarter. So just now I mentioned that we are seeing a global slowdown. And within the different segment, I would say that Asia is seeing a bright spot in the case that our growth is still stronger compared to developed markets. And our inflation in Asia is also more manageable. It's lower compared to developed markets. So in terms of both equity and bonds, I think we do see some opportunities in this space. I'm not sure if you can see here, but let me just go on to the next slide. Here I have a table to look at emerging markets, right? So when we say emerging markets, we have three different categories. We have the Asia bloc, we got the Latin America bloc, and you got the Eastern European bloc, right? So emerging market bonds last year have also seen corrections across, but I think for Asian bonds, we have been the star outperformer. It wasn't great, but we outperformed the other parts of the world. And if you look at why, look at the CPI inflation numbers back in 2022, it is a lot lower compared to other parts of either the developed markets or the other parts of emerging markets, where our inflation, yes, it went up, but it's still very much controllable. And that means that our central banks in Asia do not need to hike as much and as fast compared to the other parts of the world. So our bond market also did not suffer as much losses. Yeah. And secondly, we did see a relatively good GDP growth in the second column, where after the pandemic, the reopening in Asia have also panned out relatively well. The only exception I would say is China, because for most of 2022, China was in lockdown, right? They only started reopening in end of 2022, but as we all know, the reopening was kind of disappointing. And so if you look at the nominal policy rate, that is the central bank interest rate levels, and you can see that for most of the Asian countries, most central banks have high interest rates, except China and Japan are the outliers, where Japan is still in that zero interest rate category, one of the very odd one in the developed markets. Whereas for China, they are actually cutting interest rates, right? The only major economy that are cutting interest rates. But the rest of the central banks have increased interest rates. But like I mentioned, it's very mild. Malaysia, we know that we have high interest rate from 1.75 to 3%. That's a total of 1.25%. Compared to the US, it's 5%. Yeah? So that means that our bond market did not see as sharp a correction. And lastly, on the most right of your, the column, is what we call real yield or real interest rates. And what that means is like if you buy a 10-year government bond in those markets, when you buy a bond, right, what you want to earn is you must make sure that your bond returns is higher than inflation, right? You want to beat the inflation rate. So the higher the real yield means that the market is more attractive from that perspective. Yeah, so you can see that for Asia, most of the bond market is in positive real yield, which means that it's pretty attractive now. But it's not all the same across the emerging market world. One case I want to point out is on the last one, Turkey. Right, that is one market that we will definitely avoid because Turkey had a really runaway inflation. Like I mentioned, inflation expectation is not anchored. Inflation in Turkey in last year is 72%. And as of now, it's about 40%. That's not somewhere you want to live in, right? And what is worse was the central bank did not hike interest rate. They were cutting interest rates. So there was a policy mistake. Because of politics, they needed to show growth. They just say, oh, forget about inflation. And that's why inflation got out of control. So recently, the Prime Minister said, oh, change the governor, change the economic minister. And now they are aggressively hiking interest rate to try to control the inflation. But I think the damage is done, right? So you can see the Turkish lira has really collapsed. Yeah. So from here, what I want to highlight is within the emerging market, the landscape in Asia is a lot more stable. Bond market in Asia is more resilient. And we think it will continue to give you some decent returns in the next few years. Another part is Latin America. It's a segment that we like as well, right? So if you can have access to global bond funds that have exposure to some of these Latin American countries, but again, within that space, we only like Brazil and Mexico, where they have very high interest rates there. Now, let's move to China quickly. So China, I'm sure a lot of speakers will be speaking about, so I won't touch too much. From a bond perspective, China is one of the very few countries that are going to be looking at cutting interest rates. They have just cut interest rate in June. So that shows you that the government is concerned about the recovery is much weaker than they expected. Yeah, so the recent data coming out from China, whether it's from manufacturing, PMI numbers fell to new lows after reopening. Construction and service PMI also fell. And the property sector is still not showing much sign of recovery. It did well in the first quarter, but then subsequently, property sales came down again. So I think in China, there is an issue with the confidence as well, in terms of consumer confidence in the growth, about the property sector. And I think investors are also concerned about the last 2 years, there has been a lot of regulatory risk, right? You can see that the tech sector, there's a lot of pressure on tech sector and the property sector. And China also has a very huge bond market. They have the second largest bond market in the world. And what happened is half of the domestic bond market are actually issued by the local governments, right? The local government actually borrowed a lot of money to grow in their different provinces. But a lot of these are not doing well, their economic growth. So there's concern whether they can repay these loans or the bonds that they have taken out. So I think the government will have to do something, right? So in the last few weeks, we have hearing a lot of murmurs, a lot of rumors that China is going to stimulate the economy. They are going to announce more policy support. That's why you see that there's excitement in the bond market and the equity market. But so far, what we are checking is that unlikely to see very large kind of stimulus, not the scale that they have done before. It's likely to be more targeted to different segments that they want to tackle, unlike last time where they just print money or stimulate through infrastructure spending. Even the interest rate cuts in China, 10 basis points, it is very small, right? So it's not going to be very exciting. Yeah, so for bond investors, I think that I am still a bit more underweight in China property because we think that it will take probably multi-years to recover, and a lot of the private sector developers may not be the same. They won't go back to their glorious days back in, before 2020. But where we like is some of the state-owned enterprise. These are government-owned companies, which remains to be very strong and able to tap the market. So again, within the different bond market, we like different segments and dislike some. So my second last slide on bond valuation. I think we have not seen bond yields at these levels for multi-decades. Especially if you look at US Treasuries. You can buy a 2-year Treasury bond for 5% today. Compared to 3 years ago, it's at 0%. Right. This is a little bit outdated in April, but now bond yields have even gone up a little bit higher. And also you can see all this weird language at the bottom. US Treasuries here. So historical 10-year median is 1.5%. Now it's about 4%. Then we have investment grade corporates. Investment grade, like I mentioned, is high quality bonds. Today you can get about 5 to 6% yield, whereas over the last 10 years, they were trading about 3%, right? And in emerging market, this is in Asia and other parts of emerging market, the average yield is about 8.5%, compared to last time about 5. Of course, high yield bonds are also giving you pretty high returns, 8, 9, 10%, and even higher. So basically, bonds are actually looking very attractive. But are we at the peak? I think third quarter will be a time where we are likely to be at the peak. But if you are to wait until bond price, or like bond yields peak and to come in, it's very hard to time the market. So what I would advise is that you should have some bonds to provide that stability and income for your portfolio. And the best thing to do is to do averaging, right? To gradually invest into the market. So just to sum up, we think that inflation has definitely peaked in most parts of the world. And we think that inflation, this is the inflation indicator that the Fed likes to use. It has peaked sometime here and then it's coming down. It's a matter of how long it takes to go down to where they like to see, which is the 2%. So we think it will take probably until maybe end of this year or end of this year or first half of next year for this target to be reached. The second theme, the global economy is slowing down. That is generally good news for bond market because it means that the interest rate cycle is coming to an end, the rate hike cycle. So bond valuation is attractive. You can get very decent yield, 5% to 6, 7, 8%, right? So most of the bond funds in the market now, if you look at global bond funds, it could give you 7, 8% yield. For Malaysian bond fund, it's lower because our central banks did not hike rates as much, right? So, but the yield is still about 4, 5%. Lastly, geopolitical risk is something that we all have to live with for the many, many years to come, right? This will provide some more volatility for investors. And, I won't talk much about it. Maybe we can tackle that in our panel session later. But yeah, I'm running out of time. But I hope that you enjoy the session and we will catch up again during the panel session. Thank you.
Thank you, Ms. Teo. I hope she has done enough to enlighten you on some ideas on how to manage through volatile times using the Asia's fixed income. So I've seen some question has been posted up in Slido. So fret not, we'll attend to those questions in the later panel discussion session. So next in line, we have Mr. Kaur, who have over 9 years of experience in the equity investment industry. So 9 years of experience in the equity investment industry. His responsibilities include portfolio management as well as maintaining research coverage on selected markets and sectors. Now, I'm pleased to invite Mr. Marvin Kaur up to the stage from Kenanga Investors Berhad, bringing us a presentation with the title Investing in Uncertain Times.
Hi, testing. Okay, thank you for the introduction. Good morning, everyone in the crowd. On behalf of Kenanga Investors, thanks for sharing your Saturday with us. And thanks, of course, to the FSMOne team for inviting us. So my presentation will talk a little bit about the equity space. So, we've just come after, the fixed income expert. So unlike her, I can't really promise that, returns will be good for every year. But, I hope you do bear with us. I think the equity space is exciting and there tends to be, a lot of opportunities. But I think just to headline, to, set the stage, I think the title we use today is, investing in uncertain times. So uncertainty is, the key theme. There are still a lot of big picture items that I think, we still don't have a conclusive answer to. So, a lot of the investment strategies and, positioning needs to take that into account. I'll start it off with looking how have equities done year to date. If anyone has been paying attention to markets like the Nasdaq or maybe the Japanese Nikkei index, you'll see, performance has gone gangbusters this year. I think close to 30% return for the Nasdaq and the Nikkei respectively. But, why we say market performance has been mixed this year? I think, it's quite clearly there's only been a few teams that have been doing well. Even within the US, if you have a look at the Dow Jones, it's only done just under 4% in the first half, such a stark difference versus the Nasdaq. And, quite unfortunately, where have the laggards been? It's mostly in Asia. Hong Kong, most of the ASEAN markets are laggards this year. Thailand, they still have a little bit of political uncertainty. I mean, even 2 months now after their elections, and they are probably the, the trailing market year to date. Unfortunately, Malaysia also not doing great. I think we are down almost 8% in the CI, but small cap stocks have done, a little bit more resilient. So what other things have moved this year? I think commodities on the whole have come off. Locally, we look at crude oil, CPO, both of these are down year to date. And the other thing is currencies. I think, the ringgit has depreciated. One of the worst in the region. I think it's down 6+% year to date. But, a lot of this is a factor of how strong the dollar has been. And I'll talk about some of the factors that have been driving this year to date. So, for the global outlook, we have to start with the US. I think, I don't want to echo too much of the previous presenters' points, but I think, the potential for recession is the key theme on most people's minds. I think, this is just a snapshot. The probability of recession, which is, an expectation of most of the street, is still above 60%. I think, to recap, this is not a normal figure. It seems like every few weeks, when we speak to economists, we get different views on when the timing of the recession could be, depending on, how strong the jobs data is, how strong industrial production is. It's been ranging from late this year to sometimes even early next year. But the fact is, they still expect some sort of slowdown to come. And, again, the divergence here is, as you've heard before, the job market in the US has been extremely strong. Wage growth has been strong. But at the same time, production has been coming off. Not just there, but as you see, in other parts of the world as well. So, how long can the strong factor offset the weak factor? To look at it simplistically, will determine how soon an actual slowdown will happen. I think this leads up to probably the most important theme that affects, markets for various securities. That is contrasting interest rates and inflation. Now, as you've heard, the US Federal Reserve had hiked, tremendously last year and just started to slow down this year. From the equities perspective, what we pay attention to, is not just the quantum, but I think expectations. So the chart on the left here, you can see the orange bars. This chart has fluctuated so much this year. So I think, that reflects in how equities have performed as well. I know it's a little bit small and hard to see, but the point here being shown by the chart is the market still expects roughly 1 rate hike before end of the year. At the start of the year, this chart was showing up to 3 to 4 cuts. So I think, the change in expectation also reflects in how, the market either gets disappointed or, maybe their expectations are beaten when the Fed actually acts. So, right now, the Fed, after their recent pause, they were signaling up to 2 hikes end of this year. So if your question is there still room for disappointment? Technically, yes, if the market is only pricing in 1 cut. But besides that, how else can we predict what the outcome will be? Basically, inflation is your guide. As everyone points out, you can see a very nice sliding chart. Going down, inflation has fallen to 4%. But core inflation, as some people have pointed out, is basically been hovering near the current levels over the recent times. So it may indeed take an actual recession to pull inflation down to historical figures. Just to complete the global picture, I think to touch on Europe a little bit, their growth has been a little bit more shaky. They experienced a very large energy crisis last year, maybe they were impacted slightly more in terms of the banking and financial crisis. But what's happened this year is, the energy crisis was shrugged off, so the European markets has performed extremely well. But at the same time, you do see the same dynamics there as the US, which is, tightening is still on the minds of their monetary bodies. I think you've seen a lot of hikes from the ECB, and like the US, they are projecting roughly 2 more hikes before end of this year. And another thing we do watch out is for the Europe PMI. So this is Purchasing Managers Index. Again, just indicating the divergence between manufacturing and services. So you do see a little bit of a gap. Again, this is something we see across most markets right now. Okay, and to round up the global picture, we have to go to China. So now, we talk again about contrasting expectations and, what projections have been. At the start of the year, China was, central body was talking about around 5% growth. By the start of the year, market expectations for GDP growth was actually as high as 6%. So, with the course of recent data, the market has been revising this down. So again, it's disappointment. And that has weighed on the markets quite significantly. The positive point, I think, for most people when they think about China is what is the potential for more stimulus. We've started to see a little bit in terms of financial stimulus. So, the triple R rate has been cut, the loan prime rate has been cut. And this was actually out of expectations. Most people were expecting them to stay flat, even as the US and Europe continue to hike rates. But basically the fact that these are moving tells us that they are aware of the risk of a slowdown in China. But an additional note to this is when you have these contrasting factors with the developed markets hiking rates and China starting to cut, the natural outcome is the renminbi has weakened quite significantly. And in fact, when you talk about the ringgit weakness this year, people have started to notice, our correlation has been increasingly moving towards the movement of the Chinese yuan. So, if there is more weakness to come in the yuan, I think the unfortunate thing is, Malaysian ringgit may see more challenges still. Looking, a little bit deeper into, the Chinese economic data, I think, as Ms. Esther before me pointed out, at the start of the year, we were quite positive on, what seemed to be stabilizing indicators from Chinese data. I think a lot of rebounds were seen in various things, industrial production, FAI, which is fixed asset investment, and even like the property market, because that collapsed quite significantly in 2022. So while these this data has indeed stabilized at the start of this year, it's really not back to very large growth. We are starting to see low single-digit performance in some of these. But for us, I think the key uncertainty is actually in their external factor, which is the exports market. I think people have noticed exports collapse quite a lot in May, and this has dragged exports performance, including in Malaysia. So I think end of the day, this highlights China is indeed the world's factory, and if you do see demand slow down in developed markets, it's a bit hard for the Chinese economy to avoid some impact on their external sector. And unlike the US or even Malaysia, where domestic consumption is like 2/3, 60-70% of the economy, you have to keep in mind China's domestic consumption is less than 40%, showing how tight they are to global conditions. So, okay, I'll turn a little bit to the local market. Hopefully, there's a little bit optimism to be taken from here. I think just to sum up, the macro outlook for Malaysia is, on the most part, fine. Growth has been very strong. We have a little bit of a high base last year, but still, the headline figure is still expected to be 4 to 5%. Inflation has been coming off, like the rest of the world. Local jobs market is strong. Our interest rates have, in a sense, peaked. We had a surprise hike earlier in the year, but people are expecting BNM to kind of stay put from here on out. Where the challenges, again, where the uncertainty is the external segment. Our exports did dip in May, and as I've talked about, if the Chinese exports or Asian exports continue to dip, it's a little bit hard to avoid for Malaysia as well. And I think the last part that we can't avoid is there's always a little bit of a political uncertainty. I mean, it's in a sense not quite as bad as Thailand. So our elections didn't take more than 2 months to settle. But the local elections, state elections have again become an issue. So while this is something maybe foreign investors don't quite pay attention to, it has been holding back sentiment on the ground here. So I mean, we do have quite a few slides on the local macro, but I think most of these I've kind of touched on. Growth is fine. Where there may be chance for a little bit of sentiment change is in terms of subsidies. I think people were hoping for some of the subsidies to be maintained, but from the federal perspective, they do want to trim the government spending deficit. So because of that, people have been thinking, when will the oil subsidy, the petrol subsidy be changed or removed even? So this is something not likely to happen soon, but in a sense, it remains an overhang. Jobs have been strong, inflation has been good. These are the positive aspects I've talked about earlier. Exports, however, is probably where the challenge lies. Now, in the past, we may say that some of the challenge from exports is actually due to prices. At the very start, I talked about how commodities have come off this year, palm oil have decreased. But the thing is, the recent negative exports growth that we've had is not just in the commodity sector. We've actually seen a little bit of slowdown in manufacturing goods. So, again, tying back to the picture where, global goods demand has slowed down, sometimes Malaysia will have to take that speed bump as well. And, just to go back on expectations, initially, the start of the year, the street was telling us exports probably will be flat or, maybe, experience no growth this year. People have rebased their expectations to negative growth. So for the ringgit, I think the market is increasingly scared of giving a dollar to ringgit target. We've breached historical low levels. We are quite near the 4.7 mark to the dollar. As I've talked about, I think it's hard to see us, kind of reversing course sharply as long as the yuan continues to weaken. And from China's perspective, if let's say they do see global demand slowing, it's actually in their interest to keep the yuan a little bit weak. So, that's one challenge we do face. But, you look at the domestic fundamentals, things are fine. I think our BNM reserves continue to be quite strong, quite large. Our current account surplus remains positive. This means, as part of our normal imports and exports, the net demand for ringgit is actually still positive. So, what is happening is actually there's portfolio outflows. So I think, people have talked about how the, local equities have seen a lot of foreign selling. That's probably one of the bigger drags. Okay, now I'll talk a little bit about some of the themes where we see opportunities in the local market, because the macro kind of, it's kind of a straightforward picture from here. So, being a Chinese reopening beneficiary is a very consistent theme. Most particularly is in terms of travel and tourism. I've talked about, how maybe in terms of a manufacturing segment, that may be slow. But travel and tourism, Chinese tourists used to make up, low teens percentage of Malaysia, but they make an even larger percentage in terms of tourist spend. So, these are actual ringgit demand flows that can benefit us once this tourism flow comes back. Depending on who you speak to, they are surprised, the Chinese tourism has not rebounded as fast as we expected. But I think, the key thing to track is actually how fast the airlines resume their flights to China. So, when the capacity is only 20-30% of pre-COVID, of course, you can't have, that many tourists in person back here. So the good news is that percentage is actually starting to move up to the 60-70% mark by the end of this year. We can see this because, airlines have to book their landing slots and that sort of thing. So I think the Chinese reopening, travel tourism team will probably be a consistent performer as we start to see the improvement comes, tree development, or potentially, some of the newer works involving Penang. Energy sector reform. Okay, this one is one of those mega trend themes that we have seen a little bit of a slowdown over the last few years. What we mean by reform is basically the move towards more green energy. For those who tracked it, when we were back in 2018 with the new PH government at the time, there was a lot of focus on the RE or renewable energy team. They had very aggressive near-term targets, and there was a lot of money spent so that these infrastructures will be set up. Now, of course, it slowed down, not just because of the political scenario, but also globally. Recall during COVID, we had like an energy crisis in several places of the world. So the focus became on energy security. So, it's not just nice to have, solar plants, being built. What they wanted was to make sure, we do have energy continuing. So, there was a lot of shift back to all these older energy sources, your oil, your coal, etc. So, now that, the COVID event has, with luck, passed already, we are starting to see a reversal of this theme. Interest is coming back to RE. People are starting to spend again to build up this capacity. And locally, I think the exciting thing is there's actually a lot of government or fiscal effort to push this again. I think we've heard news that they've extended the long-term RE target from 40 to 70% by 2050. It's far away, but that's a big shift in terms of target. Then we've had other small things, like you may have heard this thing called the CGPP. It's a little bit complicated, but one of the themes is they encourage this virtual PPA program. So allowing a lot of corporates to engage in green energy generation plants to supply them, but not having it being close to their plant. To put it in simple terms, you don't have to be in a very precise location to start building up new RE facilities. And another new thing that is still in the very early stages is the potential export of RE energy. This one also, I think, has pretty large potential. I think, all you have to do is check the average electricity tariffs between a country like Singapore and here, and you can see, what the potential is if you can generate power here and sell it, basically, to foreign markets. The plantation sector is a little bit of a, kind of an underperformer for many years. I think, it's not really favored by a lot of investors. Everyone are familiar with the names, but one structural change I think that people should be watching out for is how weather patterns have changed. We've actually been in what they call a La Nina pattern for the past 3 years plus, which is, pretty unusual because the cycle typically takes, 1 to 2 years in the past. But this extended period means that if we do go back into what they call El Nino, which is drier weather patterns here, especially in Malaysia and Indonesia, the large palm oil producers, you may again see a supply crunch, which in the past has always meant, a good price reaction due to the reduced supply. And, that has benefited some of the producers on a net basis with, the price factor offsetting potential volume losses. So, I mean, not a super high conviction or structural story, but again, one of the factors I think we think, is worth paying attention to. And I can't avoid talking about this. The tech sector is probably one of our long-term structural favorites. Now, what we have seen is the downturn in terms of global semis have actually started since the end of last year. But we only started to hear of this slowdown from the local companies at the start of this year. So again, that reminds us how far upstream Malaysia is in terms of the global tech or semi value chain. The good thing about that is that we do have a leading indicator. Most of the global players are starting to see a rebound as early as later this year. Some of that is helped by the AI team. So I mean, this team has been one of the bigger pushers of markets like the NASDAQ this year, where a lot of the mega cap or large companies have been starting to be seen as beneficiaries of the AI team. So the improvement or the recovery in demand means that we are probably quite near the bottom of the semi downturn, cyclical downturn this time round. So we have quite a good bit of heads up. Perhaps the local tech companies may take a little bit longer, again with that lag, to recover. But I think the outlook, when you look a little bit further ahead, the 20 slide we have, regionally, what are we thinking? I think the US, we've gone a little bit neutral. I think you can see that there are a lot of very large outperformers this year, especially those relating to AI. For those, I think valuations have gone through the roof, very peakish instead. But on the other hand, we do have to weigh the risks of an emergent or potential recession come later this year or next year. So, on a broad basis, the US market is probably, in terms of risk-reward, not as attractive as it was. So, again, to sum up, that's a little bit of a neutral take for us. Now, Chinese market, the China market, I think the strategy here is to be a little bit more selective. There are still a lot of opportunities, we think, especially those more related to the local, local market or based on domestic consumptions. Because I've talked about, most of the challenges they face are relating to the external sector. But for the local market, especially those where sectors are exposed to potential stimulus, I think this is where you can see a little, a few more opportunities. Korea and Taiwan are markets that, these come and go with the tech cycle. And recently, they've performed quite well, basically due to the AI factor that I've talked about. but they are still exposed to the potential rebound in the overall semi scene. And when we talk about a potential rebound, this includes end demand, where things like PCs, smartphones, all this are expected to decline this year, but make a rebound next year. So for some of these markets, I think the simple way to look at it is there's probably still legs to go. Looking at ASEAN, I think this has been a bit of a challenging view to take, because everyone has been positive on Thailand since the start of the year, but it's underperformed because of political uncertainty and of course the not as fast recovery in China tourism that I've talked about. But with the decline, I think the benefit is again, valuations are looking attractive. A lot of the names exposed to these themes, which we believe are still coming, are still there. So again, there's a potential for the Thailand market to outperform from here on out, despite the very weak first half. And to round up our view, which is on Malaysia, I think we can't help but say, we still expect volatility. I think, political uncertainty remains probably one of the bigger factors, where pulling people back. So because of that, on a timeline basis, all out, increasing exposure right now is a little bit challenging. But beyond that, taking a slightly further view, I think there's still quite a number of themes we do like. Some of these I've talked about earlier. In general, what do we like is things exposed to still long-term structural trends. I think those especially relating to cycles, these we expect them to recover. In terms of more specific themes, I think the China reopening, which is travel and tourism, this is probably a decent option. Infrastructure project rollouts, we do see some tactical trading opportunities. I think on here I've talked about oil and gas, but this also refers to things like commodities, in particular palm oil, which I've talked about. High yields, in the past, people have talked about going after the high yield segment because it's a little bit more defensive. But actually, I think the position this time is, moving towards higher yielding counters actually benefits from a potential eventual cut in rates. So when the rate cycle starts to turn, actually high yielders are beneficiaries. And, to round it off, I think the growth mega trend sector, I think, it would be actually riskier to avoid this sector, especially if the turnaround may come as early as next year. I think those relating to the tech and semi space, even those in renewable energy, and of course those with a little bit of an ESG story to tell, I think that also can see their valuations supported. And that rounds up what I have. Thank you very much. Yeah.
Thank you, Mr. Marvin, for showing us some of the interesting sharing, such an interesting sharing. So up next, we have our panel discussion. But in the meantime, let me just slide in a very basic reminder that I can see some of you guys sitting down here haven't finished your lucky draw yet. So take this opportunity. You can you can just collect 5 stickers from the booth outside and then key in your personal details and place the ticket at the lucky draw box to stand a chance to win prizes worth up to 4,000 ringgit Malaysia. So, ladies and gentlemen, we are about to embark on an insightful and dynamic session led by our esteemed moderator. So this session promises to be a thought-provoking discussion that will delve into various perspectives and ignite meaningful conversations. So are you ready for some of the heated discussions? Thank you. So hurry up, open your mobile phone or tablet and start posting any heated questions in Slido. So key in the event code FSMRECFUNDS to start posting questions. So in the meantime, let's just allow me to introduce some of our esteemed moderator for this session. Mr. Kevin Kao will be moderating this session later. Okay, so allow me to invite our moderator, Mr. Kevin Kao, up to the stage, followed by our panelists for this session, Mr. Wu Manchai, Ms. Esther Teo, and Mr. Marvin Kaur. Can we give them a round of applause?
Hello, testing. Okay, hi everyone. This is Kevin here again from FSMOne Malaysia Research Analyst. And today we are glad to have 3 market experts to have some discussion about probably the strategy, the market review, the market outlook, to give you guys more insight. So as the MC have already mentioned just now, feel free to post all your burning questions in the Slido apps, right? So yeah, luckily I don't need to answer all these burning questions. So just bump all the questions that you want to ask all these market experts, and I'll help you to challenge them. Huh? So just a very quick warming up. I want to ask all these 3 experts here. Just now during your presentation, you guys seem to have a little bit of mixed market outlook. So just now, actually during my presentation, I also asked them, 2022, was it a good year? Although some of them say yes, but what's your market review in 2022, and what do you think will happen in 2023? Let's start with Mr. Marvin.
Okay. Hopefully this mic is still working. Okay. To sum up, 2022 for equities was quite challenging. I think depending on which market you're investing in, it was pretty tough. I think, we talked about the NASDAQ going up over 30% this year. Their fall last year was more than 30%. So, depending where you were invested, it was a tough time for equities. How we expect this year to go, we are hopeful for a little bit of a clawback. I think first half in certain markets like Malaysia was tough, but the opposite for certain other markets like the NASDAQ. We do hope that the Malaysian market kind of trims its losses, especially towards the second half. I think, a lot of the factors we've talked about, being under-owned or positioning for next year, we do hope that will help.
Wow, okay, so next, Miss Esther, what's your view about that?
So just now I did share about how 2022 was for the bond market. It was a very tough year. And it's a tough year from all aspects where we have high interest rates. And I think something I did not touch about in my presentation was the number of defaults in the China property sector that caused major sell-off in the Asian bond market. That was another challenging period for Asian fixed income. And I think this year we should expect a recovery in terms of bond performance. But how strong that recovery would depends on, still very much data dependent and what central banks would do. Although, like I mentioned, we think we are a lot closer to the end of the rate hike cycle compared to 2022. So, we expect bond performance this year, to range, depending on which market you're looking at. But we are bullish on certain markets like US, Malaysia, some of the Asian countries. We think it could give you maybe 4 to 6% return this year compared to the negative return last year.
Interesting. So, Mr. Wu, your view?
I think they said everything already. Okay, my 2 cents worth is that, as I mentioned, even though how bad it was last year, there's still a couple of regions that actually you make money, in India and in ASEAN, all right? And actually, if you have something in the Malaysian bond fund, actually the Malaysian bond fund will actually mildly positive towards the end of the year, and the whole year over 1% up as well. So there are always parts and pieces that whereby you have to be aware of, and I think FSM want to have the platform that can help you with that. So for me, last year was a very tough year. I think out of 260 working days, 52 times 5, yeah, 260 working days. I think more than 200 days, the market is only one direction, down. Right? The rest is flat or not going anywhere. Right? This year is much better. It's almost even, or actually, depending on where you are. And even in Malaysia, the big index did not perform. But if you have those who are a little bit more adventurous and taken a position in the small mid-cap space, you will actually be having positive gains. All right, that's the reality. And also, there's also a reflection of the structure of the Malaysian economy. Because how much more do you think that Maybank and SIMW can grow, all right? While the growth will most probably come from the SMEs around the zone. And most of our SMEs services multinationals. They are audited by multinationals. So they do are of a certain class, right? So this is something like that. So generally what it means is, I repeat, and it sounds cliche, is be aware, be very nimble, know what you are, be risk aware, and try to avoid all the noises. You'll read all sorts of funny headlines. And you go on YouTube, it's even worse. They will tell you everything is collapsing. All right? So you need to be your own, you need to sieve everything properly. That's all I can say. Thank you very much.
All right, thank you, Mr. Wu. Well, it's just a very interesting outlook and also market review about 2022 and 2023. So, yeah, let's move a little bit from the US side. Definitely coming to 2023, a lot of people, main topic, recession, because of the PMI contraction, because of yield curve inversion. So I'm going to throw this question to Mr. Wu again. Do you think that the recession, we're going to be very severe kind of recession, or it will be a mild recession, or even if no recession? What's your case for recession?
Biggest worry is your inflation do not go down. Then to break the inflation, even though it's flat, let's say at 4% now, right? It's still too high for comfort. So to break it, you need to raise interest rates beyond 6%. Effectively, you force yourself to go into a recession. That's the reality. That will be the worst case scenario. All right. And as I explained earlier, part of the US economy actually have a very shared workforce, especially the technology sector, right? But then the rest seems to be pretty resilient. But I think it's make up from the fact that most of them are contract workers, which is of different costs, right? So people are still maintaining that. I think partly maybe because of the effects of a lot of savings, money not spent from last year. After the supply chain disruption, you do not have enough manpower to face your customers. So you have various type of factors in play that you've seen such so-called resilient employment data, I would put it that way, all right? But other than that, go back, become a little bit academic, because in previous examples before the 2008 crisis, right, US real interest rates, that means real interest rates minus inflation, is always in the region of 50 to 65 basis points, the positive part. And after 2008, it was negative for a long, long time because they need it to rescue the US economy. But I guess those is over and people now are going back. At current level, if you look at the inflation trend, even whether it's core or headline, if it continue to behave as it is now, it will eventually reach something like anything from to 3.5 for headline, 4.5 for core, which compared to current level of 5.25, you're talking about over 100 basis point of real interest rates. Academically, they call it really, really tight monetary policy, all right? And whether that is something the Federal Reserve really want to pursue, I have no idea. Because as long as the GDP number going forward start to look weak, your downtrend to inflation continues, I think this is where they will have to make in their mind how their dialogue and how they communicate their policy making views more, either they are less harsh as of now, because if not, they will definitely drive the economy into a real recession. At this juncture, a lot of forecasts is, first quarter, they really miss it by a lot. Market was talking about 1.9. They came out about 1.1 or 1.3, so that's a huge miss. Second quarter, people talking about maybe near to zero. Third quarter, maybe a mild negative. So the question is whether fourth quarter is going to be another negative, all right? That's where I think will be the crunch time. And for me, this quarter is when the effect of the high interest rates adjustment would start to really be felt, and whether the GDP number will be bad. All right. Of course, unfortunately, the worse it is would means that the faster they need to cut interest rates to rescue the situation. But you must remember, currently the slowdown in European and US economy is a function of higher cost of business. It's not like in 2008, the property sector collapsed, then the banking sector collapsed, then the whole global financial system just froze up, right? Then nothing works. That's a real crisis. Here is, if nothing really breaks, then you're talking about it's just a normal cyclical slowdown. And that's why you see the World Bank forecasts have been talking about a recovery in next year. And you can only achieve such an easy turnaround provided there's no major issue that you face, right? So this is something that I will answer your question. Sorry, it's kochap.
Okay, thanks, Mr. Wu, for the in-depth explanation, right? So, Mr. Wu, just now we do mention about technology, and definitely it's one of our hottest questions because we have just experienced a very, very technology-led rally. Mr. Marvin, you do mention about Malaysia tech space. Would you like to comment some of your view about the US tech? Would you think that it's a bubble, or maybe in a layman term, do you think that this kind of rally is sustainable?
Okay, I mean, as I've talked about, I think the US tech rally has been very narrow. It's been focused on one theme. I think, you can't avoid reading it in the papers. It's basically AI. Now, the AI market, it's still supremely early in its stage. I think, in terms of how to monetize it, all that, there's probably no concrete plans or, no good guidelines you have right now. So on that basis, even 1 month ago, you can always say, this market is overvalued. On a fundamental basis, you can't tell, where the earnings of these things are coming from. The only thing is people are expecting the potential to be huge. I think just simple examples from ChatGPT has, scared people off, at how good it is at creating certain kinds of content. So, this sort of rally on a fundamental basis is very hard to call in terms of whether it's over, or how far it's overvalued, and how much further legs it can go. I think maybe the perspective to take in terms of saying, how much legs it has is, what can spoil the story. So we've started to see, news, for example, they said all this machine learning AI has been relying on public data. Some of these firms, they scrape data from everything available online. So, this is maybe more a US story, but, who owns this data in terms of personal data rights, Are people allowed to scrape this data for free? And, we've indeed seen, some lawsuits start to come up because they think, ChatGPT is probably very well capitalized, very large investors in them. Lawsuits have started to come up, we want to sue them because you took our data and you're not paying us. And this data is what makes your AI so good. So I think, when you hear more of these kind of stories start to pierce the bubble of that story, that's when you will see a larger slowdown in terms of this tech rally.
Right, thanks, Mr. Marvin. Speaking of tech, actually it made me think of a few days ago, we all know, right, China, they imposed some of the export ban of some of the raw materials to US. Even earlier this year, US already did some of this kind of stuff to China. So with this kind of geopolitical tension, do you think that deglobalization is a trend moving onwards? Maybe you can start with Miss Esther.
I think over the last few decades, we have seen globalization, right? And the theme about deglobalization is kind of getting traction because of what you mentioned, all this tit for tat, trade war, when two superpower, I think, try to grab the top spot, you tend to see all these kind of conflicts. But I would say that the world is unlikely to be deglobalized. We are very much interlinked in terms of trades, financial systems, even every part of our world. But what we are seeing is, I think companies and governments try to diversify their risk. So, for example, if you are a US company that has relied on having a manufacturing plant in China all these years for the cheap labor and all that, now you'll be thinking about, oh, I think I should have a second plant. I should be looking at diversifying my source. And similarly for Chinese companies, and I don't think it's just US and China, it's Europe as well, it's Australia, the world is kind of split into two camps, right? You have the Western and the China camp. So I think this will continue on, and it will shape investment as well in terms of opportunities, risk. And this is where we are quite bullish about ASEAN, right? Being that we do have the infrastructure, we have the labor, we have, like Malaysia, we can speak English. What we need is just more competitive policy, perhaps to attract even more FDI. So I think this theme, we will look at it as both risk and opportunities. Why risk is because it will become more volatile to invest given all these geopolitical tensions. And that will be something that we have to live with for many years to come.
Right, thank you, Ms. Esther. Mr. Wu, do you have anything to add on about this topic?
It's too late to roll back the carpet. We already walked down the carpet quite substantially down the road. Even, I think Africa itself is also inside the global picture nowadays. Although they yet to become the source of cheap labor for manufacturing now. But eventually it will come, I think. But I will put it this way. What it would mean is there will be a period whereby the governments have to sort out what can work for them. And because of what can work for the government, then will be translated to what would the private companies think will work for them because of the government policies. Like Apple is like, India now is my favorite darling already, right? Or something like that. So you have to think of how the rest is thinking. Like Esther also just now mentioned, even the Chinese companies themselves. Because if you are just a normal businessman who export to US and Europe, your product is not any incredible product, but you are sufficiently competitive. Because of the higher tariffs, you find that I find it difficult to grow further. So you will need to shift out of China. Not that you are not loyal to your country, but continuity of your business is more important as a businessman, right? So you just relocate whether to Vietnam or Malaysia, set up a plant and go forth. So this type of, maybe you can call it localized globalization. We think that China, that within ASEAN, I think we have a great spectrum. We have a near developed market, which is Singapore. Then we have a really third world country in the likes of Cambodia and Burma, eventually, if they become more stable. So we have a broad spectrum of 700 million people, whereby you can offer from the most expensive Birkin bag to the basic essential of sugar, which ASEAN itself can absorb. So this is something that you have to put it in consideration and perspective.
All right, thanks, Mr. Wu, for so many insightful sharing, right, about the geopolitical tension, right? So speaking of geopolitical tension, just now we have discussed about the development in US. Let's move to another superpower, China. So basically, my question is pretty simple. I just want to I want to include all three speakers here. Just very simple. Your answer will be buy, hold, or sell for China. Let's start with Mr. Marvin.
Wow, that's a very tough one. I'm tempted to ignore you and just go on a few sentences, but I think you can't avoid buy lah. Okay, I'll just leave it there for now.
Okay, Miss Esther.
Are you talking about stocks or bonds?
Yeah, you can go for both.
I would answer, because I get asked about China all the time. And I think as Malaysian investors, everyone in the room will sure have China, right? But I would ask you back, how much China do you already have? because you need to make sure that you're diversified. And I think if you have already a lot of China, you may not want to tambah lagi, right? But if you don't have a lot, I think it's worth to bet that, it is a very big market that you cannot avoid. So I think you need to have some exposure. For bond, I think for bond market, I am bullish on the government bonds, but I'm bearish on the high yield.
I'm going to stop you here. Just now you mentioned about you want to bearish on high yield. Do you have any reason to do so?
Okay, so for Chinese high yield, a lot of the high yield bonds in China is the property bonds, right? The other big sector is the industrial sector, manufacturing, chemicals. So if we think that the China economy is not reopening as fast, the industrial might struggle, right? And also, I think China in the last decade, they have grown a lot. The private companies, they grew a lot by leverage. Means they borrow a lot of money to grow, right? But as growth slowed down, and if the China government continue to kind of tighten or making sure that these companies don't over leverage, it will be very hard for them to survive, right? So I think for the investment grade, high quality, low leverage, they should be fine. But for the high yield guys, it will be very challenging. And that's why we think that it is, even though the yields look very attractive, you can get 25, 30%, 50%, but the risk of a default is actually very real in China. Yeah.
Right, thanks, Miss Esther. Mr. Wu, your turn.
I think just now I allude to the fact that because the Chinese market have grown to be very, very big, so that you can now actually even diversify between A share and H share, which is equities, and talking about even equity, and within the equity portion, bond part, you also have the high yield and investment grade. So if you think you do not want to further, you already have enough China. The question is, do you need hold only one type of China exposure? You may have to take the pain and restructure what you have hold in China. You can really now, if you just only one equities, then you ask yourself, can I diversify between H and A? But if you say you want to be even more conservative, I say, I want to have a diversification between equity and bond. Then this again is another way that you can talk about where you are. So for me, I agree with Esther strongly. The investment grade GLC linked bonds will be something that I will be very, very happy to look at. Or even their top grade property companies, because those will never fail. Right? Kohli, CRLand, some of these will be fine. Right? The rest, I don't know. All right? Especially those who grew very, very fast on very high gearing. That one definitely, 100-foot pole, I would not go near that. Equity will be more diverse, right? So it's a matter of where you want to be for that, on that basis, right? Because if you look at, if they are talking about policy support, the A share market will be a major beneficiary compared to H share. As simple as that, right? So this is where the diversification can take place for you for equities. All right, be all right? Thanks.
Yep. Thank you, Mr. Wu. Well, Mr. Marvin, actually just now your answer is quite short, so I wouldn't let it go that easily.
Okay.
Would you mind to explain some of the reasons? Despite, throughout the years, actually Chinese government has injected so many stimuli into the economy, but it seems like the market doesn't really react to it. So what's the reason and what's your outlook moving onwards about this?
Sure. I think, Mr. Wu kind of covered, a lot of the bases. I think if the question is specifically why stimulus hasn't helped that much, I think, they have been very careful and they've been very selective. And I think they also want to be they've been trying to be seen as not being too protective of even, some of the very large companies. So, when you saw a lot of the Chinese property companies had, their bonds basically go bust, I think, the signal is, not even the largest companies are not fully backstopped. I think that was the signal. So, but, rounding back to the question, can you avoid China? No. I think, the size is too huge, in terms of exposure, you won't be diversified enough if you avoid it. is stimulus the only thing to look forward to? Not the case also, they are attached to a lot of growth levers, relating in Asia. So I think, as long as you have the ability to be selective, talking about equities here, within certain segments, I think, you can't avoid China.
Well, thanks for the explanation. For China, definitely geopolitical tension is one of the things that we need to take note a lot, and hopefully the government will continue to be that supportive. And hopefully Yellen is enjoying her China trip, so we have more good news coming in, probably next week, who knows? Well, after China, right, let us move a little bit to our domestic side. Everyone knows the state election is coming, and everyone knows political issue is always one of the headwinds to stop FBN KLCI from growing. So from the equity perspective, Mr. Marvin, just now you already mentioned you give us some insight about your outlook for the equity. So do you think that, basically it's just very simple. What's your expectation of this state election, and what's your outlook moving ahead?
Wow, okay, that's a very dangerous question to answer. But okay, I would put it like this. The consensus view now is status quo, basically after the elections are all completed. So is there room for disappointment? Again, you have to contrast expectations and all that. So there is some room for disappointment. Now, when you talk about political risk, there's always two aspects that we are concerned about. I mean, it's not just the sentiment. The other thing is, what kind of policies may be either put in place or, be at risk after, some kind of political change. So in the case where status quo is not the outcome, I think, there are certain sectors in the Malaysian market, including larger caps, that are at risk. Basically, again, I don't want to be too specific, but there may be some sectors that have, financial impact as an outcome of potential new policies. So, just a simple risk on from a status quo outcome would be positive for the market. I think that would be quite straightforward. Yeah.
Okay, that's a very prudent answer. Let's show this question to Mr. Wu. Because I noticed that one of the top questions is our slider, right? What if, example, the green wave really comes? What is the impact to the economy?
I thought we can survive anywhere in the world. No, let me put it this way. Start from the top, right? I think in terms of hardware, there's hardly any issue with the country. That means in terms of roads, ports, power supply, blah, blah, blah. It's never an issue for us. Actually, we have some of the best infrastructure in town. If there's an issue, is somebody wrote the algorithms wrong, we just go around the circle, the roundabout. We can never get out of the roundabout for the last 10 years. But for me, it's also a sign that a number of other countries went through similar type of political uncertainties for a number of years. It's part of growing up. And the people eventually have to learn that sometimes we need to make the right decision, not because what you believe in or what you are. That's something very, very important. And the other thing that is prevalent within Asia and even in Malaysia is that Asians generally are brought up to be good at taking instructions. And, the people running the country, which we elected them, they should be taking our instructions, but they end up giving us instructions. And most of the time, because of how we were brought up, we just follow. No, I'm not asking you that you should rise up every day like what's happening in France now. No, please, not that. But you think that it's time to change, this is where I think you go to the polling station and you make the change. And you make sure that if this is the change you want and this is the current environment you want, and it should also be expressed similarly in the state election. That's all I can say. And if that is the case, then his version of status quo, or even slightly better than status quo, I hope, then we can have a decent run in the market. Because, like I mentioned earlier, right, the big caps have nowhere to grow. Maybank makes 8 billion ringgit a year. Do you think they can make 10%, 800 million additional every year going forward? That's not possible. You know how much loans growth that they need to grow to achieve that number, that's crazy. So you can achieve 2-3% a year is already superbly great. So they end up what you call dividend-paying company. What you want, if you the growth, the excitement is where the small mid-caps is, and reality is, one statistics, across the whole world, SMEs provide 70% of employment, 80% of GDP of the world, of the country, right? And you want to look for winners, usually that's what you look at. But unfortunately, by lack of size, it's more vulnerable to economic changes and political changes. So this is the only part whereby one will have to be careful of. Okay? Thank you very much.
All right, thank you for answering such a dangerous question. Well, Miss Esther, no worries, you have a safer option. I just want to ask you, what's your, just like you do mention about you kind of like Malaysia fixed income space, right? So what's the reason and what's your expectation about our interest rate?
Okay, I'll tackle the first part, the second question about interest rates. So I do think that Bank Negara is done with their rate hike at 3%. You know, there has been a lot of debate and talk whether Bank Negara had to hike interest rates because the ringgit is so weak, right? I mean, you can say that ringgit is weak because of the strong US dollars, but if you compare the ringgit against our regional peers, we are actually underperforming. So there is a lot of pressure and a lot of news. Every day you read about ringgit. When you want to travel, you also look at the ringgit, right? So I think there is that pressure, but I believe Bank Negara would not do it just because of the ringgit. They can use other measures to manage that. But I think Bank Negara also make it clear that they are letting ringgit to be market-driven. They will just manage the volatility to make sure that, you know, it's not being too volatile, but then it has to be a market-driven exchange rate. Yeah, so why I say that interest rate in Malaysia at 3% we think is quite appropriate at this point is because we are seeing a global economic slowdown. And also, I think in the latest Bank Negara, statement, the government mentioned about they are concerned about the global slowdown. So Bank Negara is more concerned about the growth. And yes, they said inflation is also trending down, but core inflation is still a little bit higher. But I think they can wait for more data to see whether there is really a need for a rate hike. But because our base case is that the US is likely to pause in third quarter, that's why we have a view that Bank Negara is unlikely to hike anymore. So moving on to the Malaysian bond market, given that our interest rate is quite stable at 3%, I think the bond market in Malaysia is also one of the more defensive bond market in the world. So just now, Mr. Wu mentioned that last year, even though in a very challenging market environment for fixed income investors, Malaysian bond actually managed to squeeze out some slight positive return, which really outperformed most of the global bond market, So I think that is a reflection of, we have a very big pool of liquidity in Malaysia. What I mean by that is the pension funds, the insurance companies, the banks, consumers like you and me, we have high saving rates, and a lot of this money goes to the bond market and be able to support the bond market. Yeah, so with the stable interest rates, we think that Malaysian bond is not going to be very exciting, but it will give you that steady return, right? So if you're looking for 4 to 5%, better than an FD rate, this is where you can invest your money.
Right, thanks, Miss Esther. Mr. Marvin, just now Miss Esther has talked about her insights or her thoughts about ringgit and also interest rate. So what's your view on, I ask you 3 questions. What's your view on ringgit, Malaysian interest rate, and also how will it impact our equity market?
Okay, that's a lot to pack into one. Okay, but I'll go in the a more natural order. I think Ms. Esther touched on basically all the key points. I think as far as interest rates are concerned, there's probably not much reason to hike further. Vis-a-vis the ringgit. Now I think I've pointed out earlier a lot of the challenge the ringgit has now is actually due to global flows and the linkage increasingly with the renminbi. So, because of that, it's very hard to tie it purely to the interest rate regime here. Even if BNM were to hike, I think they also acknowledge it may not help the ringgit much if they hike another 25, 50 bips from here. So, it will be counterproductive. So because of that, I think, it's hard to call where the bottom of the ringgit is unless you also call the bottom of the yuan. And that one, is a challenge beyond me. I think that one also involves where you think global trade will go. If a global slowdown is severe enough, I think the impact on the yuan, on the Chinese exports and trade will be even larger. Now, I think, tying back to how that might impact the market, I think increasingly we do hear, from foreign investors, I think the weak ringgit can be seen as an opportunity. If they do think, structurally there's not too many problems, I think, a weak ringgit means you do get a better entry point, especially if they also think equities can perform longer term. So, as long as, the ringgit does not depreciate too quickly and too sharply in the near term, and, interest rates are kept at, the current levels, which are reasonable, I think that should help the local market.
Right, thanks Mr. Marvin for mentioning about the weak ringgit could be the opportunity to boost the domestic burst. Well, personally, of course, I hope the ringgit to be strengthened a bit so I can go and travel. But too bad, it's a very dilemma kind of question. Well, speaking of dilemma, I believe there are a lot of investors here, especially after they have been through a roller coaster 2022. So I look at the time, we only have 5 minutes left. So I just probably have one last question to all the speakers here. Actually, initially, earlier this morning, I presented how to build your portfolio using the way of nasi lemak. So basically, just a quick introduction. If you want to build a portfolio, you need to build maybe nasi will be my US equity. Maybe I want to put a little bit of sambal like US tech, a little bit of drumstick like China tech. This is just some example. So in the case of forming your own nasi lemak, what kind of advice or what kind of portfolio positioning would you provide some insight to investors here? Maybe we can start from Mr. Wu.
If I just have 4 funds I want to buy, just take it as 4 funds. I will have 2 tactical ones, one in technology, one in China. Then I would want to have something that is protected from China. I have ASEAN and bonds. So these will be the 4 that I will have. And technology and China at any one time will be no more than 40%. But for example, if Hong Kong drop a little bit more, it will go up to 45%, technically. And if it rebound to 22,000, you're back to what it is. But my bonds and my ASEAN will generally have very little movements. I'll hold on for the stability and the income, in particular for the bonds. All right. If it's the bond side, you can break it up, right? For me, I will buy a global ETF for US government sovereign, and perhaps if there is available a Asian credit ETF, we should have high yields. And the moment cyclically the interest rates 10-year yield turn, those will provide the best returns. And it must be investment grade. It's not time for high yield yet. Too much volatility. Okay? That's how I will put it out. That's how I will play it. Thanks.
Right, thanks, Mr. Wu. Miss Esther.
Yeah, so I think if you use the terminology of nasi lemak, I think what is important is when you look at tactical funds, and I'm glad that Mr. Wu mentioned tech or like China, those should be your tactical. It shouldn't be your rise because they are very highly volatile and very cyclical. So I think, every individual investor is different, right? Depending on your risk profile, your ability to take risks, how much long-term or short-term horizon that you have. So it's very hard to be up here and tell you what is the asset allocation you should have. But personally, for me, is that after the very big correction that we have seen in bonds, we think that bond really offer a very sweet investment because you're not taking as much risk as equity market, but it can still give you a very decent 5, 6, 7% return. So for me, my bond would be my rice. And then I will have all the equity as my other, ingredients that will have that a little bit more excitement, but also give you that potential long-term returns. And then my bond will be giving me that regular income. Yeah.
All right. Mr. Marvin.
Okay, I think the challenge with going last after our two esteemed speakers, it sounds like I'm going to be copying them a little bit, but you have to give a where I hope a slightly different perspective. I think structurally, we do expect globally the rates regime should be on a downtrend. So from that perspective, you can't argue with a point. A slight overweight in fixed income or bonds it makes a lot of sense. Now, from equities perspective, valuations are at multi-year lows, and you've heard from me or many others, there's a lot of catalysts coming next year. The better parts are still to come. So from that perspective, I do want more weight in equities as well. But I think some of the challenges we talked about are structural, like when you talked about potential deglobalization or more at least polarization between US and China. So in the equity space, you can't just say overweight. I think being selective is the most key. I think ASEAN still has a lot to offer, while at the same time being very cheap, and the structural story of FDIs and etc. China, I think I've talked about, where slightly more domestic focus makes a lot of sense. And as far as developed markets, especially the US, some of the mega trends are like just to bring back the AI example, you can't avoid, or maybe the best exposure is still coming from the US. So from that perspective, they do need a fair amount of weight. Yeah.
Well, all right. Thanks all the speakers for giving us such an insightful presentation. And I would like to get... Yep, so I think that's all for our panelist session. And thanks again for all the speakers spending your time here.
Thank you, thank you. That was indeed a very, very exciting session, and I hope you enjoyed it as much as I do. Once again, thank you all of the speakers and moderators for telling us, giving us some ideas on what they think, what drives the markets in the days and months ahead. Stay tuned, gentlemen. Do not leave us. And ladies and gentlemen, for live stream viewers, we will take an hour break and the seminar will resume at 2:15 in the afternoon. We have an exciting lineup of sessions and activities planned for the remainder of the event, and we do not want to miss out any of the valuable content. But for physical attendees, we